All right, Joe. How's it going, man? You're traveling the world again. I haven't seen too many of your podcasts recently. How have you been?
Good, good. Yeah, I've been traveling a bit, like Argentina and that, and went to Florida for a hockey game. But other than that, my next trip will be back to Florida for the Rick Rule Symposium, which I believe you're going to as well.
Yes, sir.
And then I am doing some site visits around British Columbia and the Yukon during the summer before the Precious Metals Summit. And then I am looking at organizing a trip to potentially Saudi Arabia
Hmm.
and some other parts of the Arabian Nubian Shield in October. And then November, I am already booked to go to Peru for a conference there and see some more copper projects out there.
That's probably 2 hours worth of content that you just gave me to ask you questions about. First of all, what are you watching? Like water hockey? Like what kind of hockey are you watching in Florida?
Oh, this is ice hockey. It's indoors. My God, it's indoors. It's air conditioned. It's Florida. But yeah, it is weird because you're wearing shorts outside with flip-flops and you go into a stadium that needs to keep the ice below zero. So yeah.
So what do they give you like a parka or like how do you sit
No,
there
I mean, I saw a lot of people in shorts with flip-flops and a t-shirt. I wore long pants, socks, and shoes because I knew it was going to be cold sitting down there for 60 minutes. But it was a nice relief after the game. Not a nice relief because my team lost, but getting outside and back to the 30 degrees Celsius and 90% humidity was actually a bit of a relief. Uh, but yeah, it was interesting. I mean, South Florida does have some advantages.
I thought you were kidding. I thought you want to make a joke on me and be like, "Oh, look at this stupid European. He believes everything we Americans tell him." And I was like, "Okay, I'll buy
No,
it." But
no, 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 no. One, I'm not American, but two, yeah, it is weird. It's weird for me because I grew up before these teams existed that far south. Like having teams in Florida, California, and that were kind of weird.
hmm,
But really, South Florida is really strange.
okay,
Yeah, it's
yeah,
still strange. Yeah, it's still strange. But I mean, the thing is that there's an incentive there, obviously, because they don't have any taxes in Florida.
sure,
So it's easy to build teams there because everybody wants to live there and everybody would, if you got the same pay, you would take it there in Florida.
yeah. I don't know if hockey people make a lot of money, but I hope they do. Well, if you're
Oh, they
playing
don't
hockey in
make,
Florida,
yeah, they don't make anywhere near as much as, your European football players and people like that. They're not
sure.
into the $500 million or anything like that. But
Who are you visiting in Argentina though? That's maybe more topical for research talks.
oh, is this what this podcast is? I thought this was the hockey one. No, I went to go see a silver play called Abrasilver, their project Diabligios in Salta.
Yep.
So yeah, it was a nice sort of, I don't know, coming home party for me in my head because I used to work there in the 90s and I lived there for several years. And yeah, and I went back and saw how the infrastructure there has improved, how a road that I used to take, I don't know, it used to take about 3 or 4 hours to get to point A to point B, and now that is 1.5 hours. And so infrastructurally, it's so much better than it used to be. Um, but I mean, still, some of those projects are run by gas power, but Diabligios is thinking about putting in solar as well.
Mhm.
So, I mean, they don't need as much power as like a Taka Taka, like a big copper project. But still, I mean, power infrastructure is still an issue there. But, because they built so many lithium mines and they've got borate industry is picking up as well. That's more of what they do there in places like Salta is they make their money from lithium and borates, much more than metals. More of the metalliferous mines in Argentina are actually in Santa Cruz. But in terms of mining production per capita, probably the one of the provinces that sees the best per capita is Salta, and it's definitely helped that province out a lot.
I
So they're very
recently,
pro mining.
yeah, I recently spoke to John Miniotis, and so he explained that to me as well. And
Yeah. Well, I mean, so when I was there, I was down in Mendoza because I've been working with the government down there because Mendoza has always been a place that's been hard to permit, hard to do anything. But now they're trying to do this thing, and this is for me very interesting. We're talking about advances in technology and that, but here's an advance in trying to permit because when you look at soup to nuts discovery to production, we're talking, 15 to 20 years, right? Where we have done better is in the technology from, let's say, feasibility study to building. That construction period up, technology is much better. We're much better at, getting that into production. The problem is what's protracted and gotten longer is the period from discovery, permitting, social license to operate, all that other stuff to get into construction, right? And so what these guys are doing is saying, okay, here's a region, Malargüe, that has water, and we've done all the social license to operate as the government. So we've done this for you. So now all you have to do is come in, you pick the project, and then you put your budget and what you're going to do, and you get it. The best bidder wins.
hmm,
In terms of who wants to do what. So when you do this, you raise money as a junior, you come in, you don't have to wait 2 years for social license to operate. You don't have to hire 20 people for community relations. You go straight in there and you start drilling. So that kind of thing, that advance, I think that should be applied in other areas. And I've been talking to them about it because even in British Columbia, that we've had exploration for a long time, and we seem to think that we know what we're doing. The Mineral Tenure Act might put that all at risk. So I think we're going to have to start accepting the fact that a lot of these areas might not be explorable. We'll have to black them out. So it would be nice for the indigenous community and the government to tell the explorers, okay, where can I explore? So here's the places I can explore. And so I don't get that, you'll never build in this catchment area, nothing like that.
right.
And I don't find out 5 years later after I've spent 20 million bucks. So I think that kind of advance, I think is very good to try and hit that part of the discovery to production timeline, and make it shorter. So I thought that was very innovative, and I travel a bit and I see what people are doing, and I've never seen anybody do something like that. And it's proactive. It's the government doing it. It's not like it's not the Chamber of Mines that's doing it. It's this group of entrepreneurs that that can see that the tax base from wine and tourism in Mendoza is not enough to get them the infrastructure that they see next door where mining exists in San Juan. So now it's the wineries and those people that were totally against mining before are saying, okay, we can accept mining in certain parts of Mendoza. And I think that's really the eureka moment for Mendoza, and I think that can also be adapted to a lot of other places.
And I'm happy to see that happen for Abrasilver, right? Because it's one of the better. I don't have any interest there. So I don't have to say this, but it's one of the better silver projects out there, right? Which I suppose is that what attracted you to Abrasilver in particular? Like, did it start sort of bottom up for you, where you start at the asset level, or are you just looking for diversified silver exposure?
Well, I mean, yeah, well, you'd want some silver exposure, and so the problem is now with Mexico. I'm out of Mexico. I'm not going to touch it. And then
Not
you
even
look,
go
okay,
gold.
no, I sold my position there. I'm not even sure that you could do underground that quickly there.
And that's
It's
unfortunate too, because it's a great. I mean, everything seems great. I interviewed the guys there too. I don't have any interest in that either. So, but it's just, I mean, again, good deposits kind of being kneecapped by jurisdiction. So yeah, but go
Yeah,
on. Yeah,
I mean, yeah, if I have to talk about the government every week about what they're doing,
sure.
that's
Yeah.
not an exposure I want.
Mm.
And now, got the last presidential election, and they've gone to a person that's a climate scientist, and she won a supermajority, which means she's got Congress and the Senate. And so a lot of the stuff that AMLO couldn't do, she can. I mean, the ban outright on open pit mining that AMLO couldn't run through, she can. And, much of the momentum that she garnered from the win was driven by AMLO. And so it's not like she's going to turn her back on him. So I see another 6 years of sort of problematic, issues for miners, explorers, and everybody in Mexico. So that is good for silver. For me, I still like Peru. It's not like that's another big silver producer. But Argentina, the name Argentina, Argent is silver. And so they do have some silver projects. And Diablillos is a project I've known for a while, since the 90s. The problem was always metallurgy. But at that time, silver price was low, and nobody thought about doing anything more than a heap leach up there. Heap leach does not work with the kind of mineralization. They've done a vat leach. They're down milling. That's the proposal for their feasibility study, and that garners a better recovery. And the fact that they found the Jack deposit, which was over and above Oculto, which was what Barrick was drilling, is a positive to say about the entire exploration package. What else is there left to find? And that's what I went there to see. Is they've got 20,000 meters of drilling coming up. They got a small private placement from Kinross and an Argentine company that builds solar plants. So now they're doing that. So that's really what I'm looking forward to, is seeing that go. And just one more thing is that with Argentina as a whole, Abrasilver is in Salta, not Mendoza, but Salta is one of the best provinces. Salta, San Juan, Jujuy, less so Santa Cruz, but those are the best provinces in Argentina. Now the federal government has come through and said, okay, you know what? We're getting rid of the duties on metals. So there was an 8 to 9% on exporting metal, like precious metals outside. It's almost like a royalty. That's gone. Now, I mean, the corporate taxes are lower, but that's nowhere near as impactful as this, reduction or elimination of duties. And they're also, I mean, making more, they're just incentivizing foreign direct investment right now, which is something the federal government has never done. So even though provincially, Salta has done really well with the Jujuy, with the lithium as has Jujuy, even with the federal imposition of higher taxes, these duties, and blah blah blah. Now those are being removed, so that's just going to make the economics of these projects a lot better. So what I'm looking forward to see is, does that bring people in that were never in Argentina? The other big problem was that you couldn't take money out of Argentina. And so financing a project in Argentina was next to impossible. It's going to be a lot easier for Abrasilver now, because now you can take the money out and the debt holders will be better. They won't be as, they won't have Argentina as a sort of a place we can't operate. So a lot of positives came from that time in Argentina, because that bill was just being passed while I was there.
Interesting you should bring up Peru, though, because I've always kind of thought about Peru as a copper jurisdiction, obviously, for the porphyries. But who are you looking into for like this? I suppose there's a Silver X, this tier 1, there's Kuya, hopefully not Silver Elephant, but I don't know what you do in your own time.
Yeah, but I mean, you got to know Buenaventura and companies like that, and they're big silver producers as well, from low sulfidation veins that have a lot of base metals, but also carry a lot of silver. And so those are the types of sort of deposits you'll find there. Yeah, so I'm going to go see an epithermal breccia project run by, I think it's Highland Silver. This was a project that was in the hands of
Highlander. Yeah, I forgot them. Yeah.
Yeah, it's Highlander, actually. That was formerly Esperanza, and it's like a small breccia body, but they have a lot of exploration upside there that was never exploited before, and that's really what I'm going there to check out.
Okay, so it's just one project that you're checking out, like you're not batching.
Yeah, I'm going to check that one out, and I might check out a copper one as well. while I'm down there. So there's a conference down there on exploration that a guy does the same thing in Chile. Now he's coming back to Peru to do one there. And that's a good sign for Peru because Peru now is going through the logjam of permitting and all the issues they had during COVID and going through a presidential candidate every 6 months. They're really definitely trying to get on the front foot with respect to making sure foreign direct investment doesn't leave the country anymore.
That's where the guy got murdered, right? The presidential, was that Peru? Am I messing that up? Earlier this year, was it late last year? Something along those lines. One of the presidential candidates got murdered. Let me see.
Oh, that was Ecuador, I think it was. Yeah, that was Ecuador.
Okay, I'm way off.
Yeah.
People are gonna
I
hate
mean,
me
it's
for that,
just the
but
next country over, just the next country to the north. But yeah, Ecuador has a lot of crime happening now. It
yeah.
is a crime ridden because of the drugs and that they're having a problem with. A lot of those gangs are now a big issue in Ecuador.
Yeah, I spoke to David too. David Fincham, he's the CEO of Highlander Silver, about the La Estrella project. Yeah, I had a good impression there too. What about Bolivia? That's someone else I also recently spoke to. New Pacific Metals seems one of the
Yeah.
best silver projects, one of the best projects that you can get exposure to. What do you think there?
I don't touch Bolivia. And this latest, attempted coup sort of proves why I wouldn't touch it. You never know with Bolivia what you're going to get. I just stay away. I mean, there's for me in South America right now, my exposure, Argentina, Brazil, um, Chile, somewhat, and Peru. Northern South America for gold, Guyana still, probably number one. Um, but I don't touch Colombia and I don't do Ecuador.
Hmm. Well, I'm talking to Elaine Ellingham later today. So out of Omai Gold, there in Guyana. But yeah, it's an interesting. It's interesting that we kind of started talking about silver because that's not typically how you approach your portfolio, right? You don't start top down. Like you're not, oh, a lot of money printing, gold and silver are going to go up. Let me get some silver exposure.
No, but there is a top-down aspect. So every year when I start the year, I look top-down with respect to not so much, there's that, macro crap that we all talk about, but for me, it's really the supply side, especially on the what I would call the marginal price-driven industries, marginal cost-driven industries, where P equals marginal cost in the long term. And so copper, all the industrial minerals, I would try to figure out, okay, so who's going to have the big production gaps, and what stage do I want to be in? Do I want to be in exploration? Do I want to be in development? Or do I want to be in production? In copper, I wanted to be in everything. I wanted to be in production to get, exposure to the leverage. I wanted to be in development with respect to there's not a lot of development projects out there. And I definitely wanted to be in exploration. There's not too many metals that I'm in every stage.
Hmm.
Because that's just my bullishness, underpinning copper.
I do
But
want to talk about that because you said you're going up to what did you say? You're going to see some stuff in BC, which is easy for you, close to home. But what I also want to talk about, and I like talking about the macro. The macro is going to get you the views. You just tell me that silver is going to $100, we're going to have 20,000 views, no problem. But what I'm thinking about is, what do you think we'll see over the next few months within the junior space specifically? I mean, to me, it seems like it's going to be mostly softness in the market, but it doesn't have to be. But we're going into the summer doldrums. The macro doesn't seem to be moving too favorably either. So what do you make of the upcoming couple of months within specifically the juniors?
yeah, the problem is still we have a problem with if we just talk about precious metals, we still have an issue with people like the retail sector. They're not really in it. And so financing is still problematic for these people, unless we're in Canada and we have flow through. But now flow through might be problematic in Canada with the increase in capital gains tax. So they might make flow through less attractive for high net worth individuals. And if that's the case, then that spigot might get reduced as well. And so these companies going into the summer, which is our field season, there's less projects out there with the money to actually drill. And when we're talking about drilling in parts of British Columbia, we could talk about $500 to $1,000 a meter Canadian to drill, because it's remote, because it's helicopter supported. I mean, even in the US right now, drive access, no camps, we're talking $450, $500 US per meter. Not cheap. So these people need more money to drill the same amount of meters. But now the market is such that, there's not a lot of capacity. So some projects will get most of it and other projects will get next to none. So that issue remains. The gold price is flat to going up, but that's not impacting these people because that's not what's driving the gold price.
It's true. Well, what do you think is going to impact those people? Like, what's going to make the share prices in this period move, though? I mean, with some of these juniors, they don't seem to move on seemingly good news, well, decent news in terms of assays or whatnot. And then the only thing that moves stock prices is uniquely high grade. Like, you talking about cheap jurisdictions, talk about West Africa, Wale Resources, which I am biased because I own a bunch of it. But so, I mean, they had an amazing haul, moved a lot, right? But you do anything less than that and the market doesn't care. So what do you think is going to actually start moving these stock prices eventually?
Well, if we stick to precious metals, it will be potentially M&A, with the idea that, these stocks are going to get more expensive. Right now, nobody's worried that they're going to get that much more expensive. So we don't see a full frontal on M&A. The other thing would be, I think, from the macro down, is to start seeing interest rate cuts. Interest rate cuts will bring institutional equity back into gold, and it won't just be the central banks buying, it'll be inflows into ETFs. That will spill over into the equity markets, and that will turn the tide. Right now, that tide is not turning because, again, central banks buying gold, central banks they don't buy equity. They don't need leverage to gold. They just want gold. So if you want that kind of exposure and you're convinced, okay, central banks will keep buying, gold will keep going up, then, maybe royalty companies, something else that might be a better exposure to precious metals than companies that are non-cash flowing and constantly have to go back to the market where the spigots are drying.
I don't know if I want to live in a world where central banks want to own junior mining stocks. I don't imagine what that would look like.
No, absolutely not. But but I mean, we're asking a lot from the government. I mean, now in critical minerals, that's a major source of funding for some of them, is to attract government funding. And if you are worried about, paying taxes and the efficiency of your government in terms of allocating the money you've given them, can you imagine having them trying to decide which project works and which doesn't? That's where we're at right now with a lot of projects,
Yeah.
and it's very
Yeah. And then,
scary.
well, it is true. A lot of it is happening in the US, and it almost seems like they just have to check boxes. I mean, they're like, oh, we have all this money. What's critical metals? What's a good project that's moving? Let's give them the money so we can check the box, clock in, and go
Well,
ahead
I
and
mean,
clock the box. So,
example, nothing against the project. I visited several times. Perpetua, the stibnite project. Stibnite means, that's an antimony sulfide. But in terms of the in situ value of that project, 90% gold, about 10% antimony. But the volume of antimony that project could potentially produce would basically satisfy, the US demand for antimony. So they're willing to give it almost like 60 to 70% of its upfront capital in, cheap loans from I think it's the Export Import Bank of the US, so maybe 1.8 or 1.6 billion of its 2+ billion required upfront capital. I mean, if it ever gets permitted, there's no linkage between a letter of intent on giving you some money and whether you actually get permitted. Those are two different branches of government. But that's the sort of place we're at. Thacker Pass. I mean, that's claystone lithium, very capital intensive and power intensive because they need a sulfuric acid plant. And so I think that's, easily over a couple of, almost $1 billion, I don't know, 1.5 or something like that. I can't remember. But a lot of that money comes from Ford and the US government, to build the project. It wasn't coming from, let's say institutional equity or anybody like that.
Yeah. What are you going to Canada for? You said, wait, so you're going to South America, and then you're going to Canada?
No, Canada's in the summer, so I'll see another silver project. I'll see Dolly Varden.
Okay.
That's drilling a lot, so that might be of interest. And then Brixton, which has a huge land package up in northern BC. So that trip, I'll go up there from Whitehorse, and while I'm in Whitehorse, I'll go check out Gladiator as well,
Yeah.
which is a copper exploration project, skarns that I own.
Yeah. I just spoke to Brixton too last week, actually. It's interesting what they've been at it for a while now, right? The thesis is
Yeah.
changing somewhat. Do you like the new thesis better?
Well, the thing is, it's a huge land package, and there is probably some risk there in terms of them maintaining that size of a land package, which any changes in the BC Mineral Tenure Act. But they have probably enough land there, and they've done enough work, and hopefully they're doing more work now to basically prioritize land just in case they're asked to reduce.
Mm.
But yeah, I think it's a very interesting area. Remote, but there's potential there to find a major porphyry. But
Yeah.
you're going to need the grade there to justify the infrastructure and the upfront capital required for projects like that. But since it's in British Columbia, it's closer potentially to a grid whereas Casino needs about $1.7 billion to, get on the northern part of the BC grid. A project that you could find in Brixton would cost less money to get on the grid.
Yeah. And so, but still, it's not. I mean, it is remote, because so you're gonna have to fly to Whitehorse, I assume, and then a 45-minute flight on a fixed wing or something like that to the
Yeah,
project.
yeah, exactly.
Hmm.
Exactly. Something like that, an overnight camp.
But BC is interesting though, because things seem to be changing there in terms of regulation. Something that I don't see talked about a lot out there, but I know you've picked up on it. What do you make of what's happening in BC now
Well,
with the
anybody
government?
that knows anything about BC knows this. The problem is the companies don't talk about it. It's the same thing with Mexico. When the Mexico changes in regulations, no company put out a press release and talked about it in detail because, there was a lot of uncertainty, but they didn't want to say anything. One, that they didn't want to appear critical on the government, probably, but there wasn't a lot of news out there. What you did see is, money moves faster than a press release. And so you could see companies slowly take out money out of Mexico exploration, because, the way that they were thinking about doing exploration just didn't make any sense. So you see companies that do project generation in Mexico basically getting out of doing that. Nobody wants to do deals there. Unless you get somebody that already owns the project, but then now they're looking more at people's taxes, whether they paid them or not, and blah, 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 blah. BC right now, with the First Nations groups who sued the government in the Supreme Court of British Columbia, won. That was last year. And out of that, one of the outcomes was that the Supreme Court of British Columbia told the government, which happens to be left wing right now, the NDP, New Democrat Party, that they have to sort out their Mineral Tenure Act, and they had whatever 10 to 12 months to do it. We've got another whatever 4 to 6 months left there. Right now, we're in basically a bit of a no man's zone in terms of we don't know what's going on, and the new regulations will come. But I don't know if the industry, I mean, explorers, people that prospect, understand enough and are probably thinking that they haven't given enough input into what the new act will look like, and they're kind of concerned. So, for me, I do approach BC with a bit of trepidation.
That's again another unfortunate thing because you said you want to be involved in copper at all the levels basically, and then I mean if you want copper exploration in a safe jurisdiction, you go to BC, right? That's kind of been the norm for a very long
Yeah,
while.
my problem with BC is more infrastructure, how much it costs. Most of the deposits are low grade, so I'm not head over heels in love with British Columbia,
Hmm,
in terms of doing anything there, in terms of
yeah.
copper. So where do I go? And production, I've gone to Brazil. Exploration, I've gone to Peru, which is highly endowed. Um, Stick my foot back in Chile, um, Argentina, and the Macquarie Belt of New South Wales and Australia. So yeah, I like Zambia, but it's hard for me to get exposure there. But I do like that in terms of getting exposure to the Central African copper belt. So yeah, I'm definitely looking around. But yeah, BC, the problem for me was more so grade and the remote nature of most of the deposits, in terms of upfront capital.
What do you like in Zambia? Like sedimentary copper deposits?
Yeah, I mean, the weirdly we call these things sediment hosted copper deposits, but as you go see each individual deposit, each one is very different and looks very distinct. And there's basement deposits like Lumina, and people are looking for those. And then you have the actual sediment hosted deposits that look like more like Kamoa Kakula.
Hmm,
But I can tell you that there's a lot of people interested in Zambia. And you could see what happened with First Quantum in Panama. Most of that money that they lost in Panama is getting invested now. Their focus now is back on Zambia, though that's the only project that they could sell to help pay off the debt, but it's definitely not something that they were looking to sell
hmm.
because that has become a big priority for them because they've got a smelter, big mining complex, and now with the rail coming to the DRC, there's opportunity to put a spur into that part of Zambia as well and take the copper out through the west.
Who am I thinking about? B metals. Is who I spoke to with a
Yeah,
project in
B
Zambia.
metals is a good one, and that's in the western part of Zambia.
Mhm.
John Wilton is a very good geologist. He spent a lot of time there, and so those are the kind of guys you want to get exposed to, because they're not, just showing up. They know the area. They've been there before. They're not going to get fooled on somebody selling them a project everybody knows is a dog. So yeah, that one I do like. I do like that one. I don't own it, but I do like what they're doing.
What do you think of the West Birimian greenstone belt in West Africa? There seems to be some copper grades picking up. A lot more things are cooking in West Africa these days.
Yeah, I mean, they talk about IOCGs there, iron oxide, copper gold deposits. I'm still kind of concerned about security in a lot of places in West Africa. And copper deposits are 30-year things, require a lot of upfront capital, unlike a gold deposit, which might have a 8-year mine life. So you really need infrastructure, and you really need to be happy that it's going to be there for a while, because you don't want it to spend like $2 or $3 billion building a project and then finding out that you can't operate it.
Mm.
And I'm hearing a lot of not so nice stories about Russian mercenaries around in West Africa as well, taking money away from some of these gold projects and holding them for ransom to try and, get them to pay protection money. So I'm not super keen on that. I think on the other side, the Arabian Nubian Shield, where there is capital there to get funded from Middle Eastern money. And if you really want to follow capital, just follow the Friedlands and the Bristows and see where they're going with their projects, and they're heading to the Middle East and places of Asia that could get funded by either Dubai money or Saudi money. And so even though Pakistan for us seems like geopolitically a nightmare, that project might come into production before Resolution, which is in Arizona, which has been, I don't know when it was discovered in the, I don't know, 80s or and when I worked for Phelps Dodge in the 2000s, we had that project coming in 2010. It's 2024 now. So but I mean, he has no problem attracting money. He's not attracting money from North American funds or anything like that. He's attracting it from Middle Eastern funds that want to get involved in this green transition for their own region, and they want deposits that can feed into it, like copper deposits, like Reko Diq. So that's so you see a lot of that happening, and that's what you got to think about as well, is that if capital is tight, where can capital come from, and who's going to get funded, and where, that's one region that I'm looking at again. And problematically, you got to look at where you go. Still geopolitically, some places are much more difficult than others.
If I look at what Robert Friedland's doing, though, he's there's just this week there was news of him restarting. Well, Ivanhoe Mines restarting the Kipushi mine. Kipushi was placed on care and maintenance 30 years ago, before I was born, actually, and but it's in the DRC, and you've been historically skeptical of it. Would you follow Friedland into the DRC?
I have. I've owned Ivanhoe before, and it has been one of my best return projects without doing a private placement, buying on the market, selling on the market, and making about, I don't know what I made on that one, 8 to 9 times. That is what you want. You don't want to start hobnobbing with management to try and get a private placement and a 5-year warrant at a 30% premium. That's where you make money on a great deposit. I mean, I got it because I thought it was undervalued where it was, because I got it at 60 cents. When they had Kipushi, they had Kamoa with the feasibility study, they had the money coming in from Zijin, and I thought, wow, this is cheap where it is. It IPO'd over $4. And then it was at 60 cents. And and what drove that wasn't Kamoa, wasn't Kipushi, it was the discovery of Kakula. That's what drove that. And so those are the sort of projects that if you can find a project that's undervalued for what it has, but still has exploration upside, that's what you want. And if they can quantify that exploration upside while giving you that underlying value on the assets that they already have, that's good play, especially with a management team that you can trust. And that's like fundamental, because they know how to allocate capital. They're not going to blow it. So when they find a Kakula, they're not going to go out and, go on a safari or something like that. They're going to keep drilling that bloody thing and show that. And then that one came into production quicker, because it was just so high grade. I give you another example of that. I think that's developing is Bravo Minerals. So I went to that a couple of years ago. I took it in a private placement, but I never put it in the letter because my subscribers could not replicate my placement. It would just be looking like, hey, I just made a lot of money. You guys would never have been able to do this. So I never brought it in. I brought it in more recently because it traded at about $1.50. And it had traded up to $5, but now it had the project Luanga defined as a PGM. Everybody hated palladium. I thought, okay, this is a hated sector. Let's get some exposure to this hated sector in an asset I knew, I visited, I like management. I'll just buy it. Then a month later, they drill some of these electromagnetic targets from an aerial survey, and they hit copper because they just happen to be in the Carajás mineral belt. And that's got a lot of iron oxide copper gold deposits. And when they did the EM survey, they expanded it beyond, the PGM deposit, Luanga, because they thought, well, we don't know what else is here. and their T5 anomaly, they hit some really high grade copper, and that brought their stock back up to over $3.
Yep.
So that was a nice double. But again, this was a company that had an advanced study on a PGM project, so they already had some underlying value that I thought was cheap. I knew management. I've already been to site, so all that work's already been done, and now they found something else.
Yeah.
And what's driving it now is a $3 million initially exploration program. That's what doubled their market cap, added about $110 million of market cap, that drill hole.
Yeah.
So so that's what I'm looking for. But I don't need to do that in a $10 million market cap company, because the problem is they're always going to go back to the market. Whereas these guys have already had access to the market, already had money, and have enough shareholders that'll give them money. And so in these kind of turbulent times, I mean, if you're not getting the money from the Chinese or the Saudis or something like that, it's harder to get money. So you need to be in a jurisdiction where people are happy, giving you capital for. And Brazil is definitely one of them.
Do you think that, to go back to Bravo, I kind of followed it a little bit, not too much, but they drilled that hole, pumped their stock up. They drilled that hole where they said, oh, this looks like it's going to be an IOCG. Then they came back on the back of that with the assays, which was almost 10% copper, I believe, if I'm thinking about the same thing. T5. Okay.
Yeah, the T5 anomaly, yeah.
That's right. And so it went from $2 to almost $4 now. And actually, it was over $4. It was 4.40 at a certain point. Adding over $200 million of valuation to the market cap on one discovery, do you not think that's a little rich?
Yeah, it is, but I don't mind because I own it already. Would I go into it now? Maybe not. But this was not unlike. Yeah, I'm not saying it's Kamoa-Kakula or anything like that. I'm just sort of trying to draw the analogy between management, asset, access to capital, and an exploration discovery. Very similar. And I did very well with Ivanhoe doing that. But I didn't expect Kakula. I didn't buy it with the idea that they would find Kakula. That just happened. I didn't buy Bravo with the idea that they would find the T5 anomaly or start expanding this drill program onto that. I just bought it because I thought for what they had, it was undervalued. They had cash. They had a project. I understood the metallurgy. I understood the resource. I'd already been to site. I liked management, checked all the boxes, and that was cheap. But now they've gone and done something else. And which, that's all value add. That's all for me upside. And I didn't need the palladium price, the unwanted sort of sector or the hated sector that I was thinking would turn around. I didn't need that to change. I got it from something completely different because I'm in a very highly endowed region, the Carajás, just like Kakula is in a highly endowed copper belt, the Central African copper belt. So if you can find yourself in those sort of belts and tick all those other boxes, get it cheap, you could do very well without looking for a private placement, without thinking about a 5-year warrant, without any of that crap.
Yeah. You still need luck, though, I assume. In your case, you have a combination of skill and luck because you actually understand the rocks. And when they tell you, hey, we've got exploration upside, which they're always going to tell you that.
Yeah, oh yeah.
You can judge if that's actually true because, as we discussed earlier, like none of these things are moving. There's a bunch of companies out there with $1 billion NPV and a $70 million market cap, or $500 million NPV and a $40 million market cap, like Omai, for example, that I'm going to talk to later here. But so, yeah, I mean, you need luck for that exploration upside to materialize, or you need a combination of a lot of knowledge and then still a little bit of luck.
Well, but you got to go in there knowing that you don't need that. The problem is when the market is very hot, you're paying $50 billion of market cap without even a hole. Or like when lithium was very hot, there was a project in the Northwest Territories that it had a market cap of $350 million and it hadn't even drilled a hole yet. That's what I would not buy.
Yeah.
You know, what I would buy is the company with the market cap of 150, 200 million that already got a project that's got a decent NPV, that it's trading at like a 0.2 times NPV on it. It's got cash. It's got the management team I like, and it's in a jurisdiction I like in a highly endowed sector. Then, if they find something, great, because I've got the downside protection on that one. You know, but if I go and buy a $350 million market cap company that hasn't even drilled a hole yet, it's got to backfill that value. That's hard to do.
Yeah. Yeah, those are wise words in terms. I mean, it goes back to risk reward, I suppose, because your risk there is how much. I mean, if you buy that company, well, actually,
Well, the
my
thing is that
experience is
that $350 million is telling you, well, what does the market already giving it? Like it's already giving it whatever, a 500 million ton, 1.5% lithium oxide deposit. Is that what it's giving it? And go, so if they don't come anywhere close to that, you know, it's obviously not worth nearly as much. And so every hole you're on, you're like, you know, God, I hope they hit something because the market's already telling me that they have it. You know, and if they don't have it, you know, you're going to come crashing down. So that's not the risk profile you want to get into.
true. And you still need the stock market gods to favor you, because if they don't favor you in a particular year, you can have a stock that's down 90% go down another 90%. But that also takes a special type of stupid, and I'm speaking out of experience, unfortunately here. What
Yeah.
are you doing in? You said you're going to the Middle East. We touched upon it when you said on the other side of Africa, you meant East Africa. Still a lot of challenging stuff in East Africa too.
Yeah.
I like some stuff in Ethiopia. Not the best jurisdiction right now, to put it mildly. What are you looking at over that part of the world and the Arabian Nubian Shield?
Well, I haven't booked yet, but I'm looking at Ethiopia, which a place I haven't been, but I've been to Eritrea and I've been to Egypt, and I really want to check out Saudi Arabia because you know they're really pushing exploration, and it's almost like back when they found oil, they brought in all these expats to help them develop the oil industry. Now they can do it themselves. Now it seems that they're doing the same thing with the mineral industry. Is like when I went and did my mineral economics degree in Colorado at the School of Mines back in early 2000, there was a lot of Middle Eastern people there, but mostly because of the oil, not because there was only one Middle Eastern guy from Oman that was actually there for mining. Everybody else that was there for oil. I'm sure now they're sending a lot more people to these universities in the States to study mining because that's definitely something that they're pushing, and they don't lack the capital to do it in terms of, but you know, they have to have the endowment. They have to find where they can get the mineral to feed their processing plants if they want to make this big green transition.
Hmm.
Capital, they do not lack. You know, and they're going to be determining the jurisdictions. And jurisdiction, geopolitical risk is in the eyes of the beholder. So it's that person that's spending the money that thinks about geopolitical risk differently than you would. So you would think, well, I don't like this country because blah, 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 blah. But then they might not have a problem with it. And if that's where the source of capital is, that's where the money's going to go.
Well,
And
if
they might
money,
not be a Chinese company, like a Chinese company, they can't invest in Canada. So, you know, Fission gets taken over by an Australian company. You know, there's no Chinese bids for any uranium projects in Canada or Australia. And those are the guys that are probably the most aggressive. You know, are we going to see, even the Chinese are worried about places in South America. You know, where can they and where can't they go? Because they're not super keen on Peru, even though they have a producing mine. They'll push into Ecuador. But you know, whether the new government in Argentina would want them to build big copper mines in Argentina is a question as well. I mean, they are producing lithium, but do they want them? Because no country in South America right now wants to just take one side. The eastern side, which is led by the Chinese, or the western side, which is led by US and Europe. Nobody wants to do that. And I think that's a smart thing to do.
Yeah.
So
Well, Africa
now
seems to have
Chinese.
made up its mind, though, in most of these countries. In a lot of the, I shouldn't say most, but in a lot of these countries, Africa seems to have made up its mind, and they're not going with the West.
Well, see, I disagree.
Mm.
So back when they were developing, they had no choice. It was only the Chinese because, the US was not thinking like this. They weren't thinking about critical minerals. They would get it all from China. China, expanded their processing capacity. They would buy all the technology, the washing machines, the televisions from there. But now they're worried about supply chain. So when I was in Indaba last year, who was there the year before in November talking to Zambia and the DRC was Anthony Blinken, the Secretary of State. And so that was part of building that, refurbishing that railway that goes to the Port of Lobito in Angola. Because if it goes out east, it'll probably mostly be Chinese infrastructure. But if it goes out west, you can get out to a port and take it to Europe or the States. So they're changing in terms of, and what they realize that it's easier to fund a project in Africa than it is to fund, permit and develop a project in Africa than it is in the US. I mean, you saw just recently, the Biden administration put that final, I think, death knell on that Ambler Access Road in Alaska
Sure.
that would have built the Trilogy project, the Arctic project, the VMS with South 32. And so, the harder you make it projects to develop, but still are pushing the green agenda, where are you going to get the metal from?
Good point.
That's a big question. Where
But
are you going to get it from?
well, something.
They're definitely behind the eight ball with respect to Africa, but I can tell you a lot of African nations are kind of tired of the Chinese and how they're not using their people or developing their own people. Like, that's not happening. I mean, usually when China comes down and they build a mine, build a fence around them, bring their people in, develop the project, produce, and take the metal out.
Mm.
They're not interested in integrating in society that much. When you see a big company like your BHPs and Rio Tinto, when they go to a new jurisdiction, they develop people locally there, and then they become the new expats. So, in 20 years, now the expats are Peruvians, they're Chilean, they're Argentine, they're Brazilian, they're whatever. So, we'll see more African expats, because that's where the engineers are now. That's where the geologists will be. So even though we're worried in the West that, we're not producing enough of these people, they'll develop in other countries,
Mm.
because that's where the mines are.
Yeah.
So I think that the US is turning, but let's see, because, if the presidential elections, bring on a new president, that's the problem right now is nobody trusts anybody anymore because the administration can change in 4 years and the policies can change.
Well, thank you for doing this, Joe. There's always loads to talk about. I guess I'll see you soon, as you mentioned. Hopefully, we can pick it up again. Hopefully, you're not bringing me to any hockey games there, though. But I'll let you drop off for now, as I can, so I can jump into my favorite part of the CEO barbecue here, which is, of course, the disclaimer. There is a warning on your screen right now for people watching and listening now that you're basically obligated to read it, I suppose. But it will behoove you to do so. Look at me saying big words here. This is not just some disclaimer. It's an actual warning that will help you not lose money. So if you care about these things, if you care about not losing money, pause the screen, read it. There's going to be another disclaimer right after this. But um, you should know that I'm here to make money. Okay, that's part of the disclaimer. I make money from the existence of this channel. Okay, and specifically from companies paying for the production of these interviews. So I would like you to be aware of that fact. Some companies that you see on this channel, most don't, but that doesn't really matter. But some companies on this channel will have paid for the production of their interviews. In this case, specifically, Lumina Gold is a paying advertiser on this channel. But even the companies that are not paying, again, which is the majority, they are still likely seeing their participation in this program as a chance to do some marketing. So start by understanding that most companies that come on here, most company communications that you're going to see online, whatever that might be, it's oftentimes it's interviews, it's presentations, it's websites, Twitter accounts, it's conferences and whatnot. Those are marketing tools. Okay. And although I Don't make buy or sell recommendations, because in my opinion, there's a clear conflict of interest to take money from the company and then make a buy or sell recommendation. Many out there will do that, and you should be aware of that inherent bias. That bias won't always be clearly disclosed with everyone out there. So it's safer for you, anytime you're watching any type of company specific content, anyone mentions the name of a company to you, just approach it thinking that they're biased. Approach it with a dose of skepticism and treat it as marketing. Use your brain accordingly. Although I try to be different than other interview providers by looking into more than just the presentation or just the front page of the website. And unlike most, I don't give the companies the questions up front. It doesn't matter whether they pay me or they don't pay me. They get no questions up front. There are no questions off the table with me, and the companies get no say in what ends up in the final video. Even though that is the case, these things should still be looked at as advertisements, not as research, least of all as recommendations. Okay, there is a bias in between, and you should really be aware of that. And unfortunately, I'm not a magician. I'm not even a musician, although I am an aspiring one. I don't, I don't possess any special knowledge about what will go up and what will go down. So no guarantees here. So the fact that you see these companies on here doesn't mean their stock prices are going to go up. It just means it's a company I'm looking into and I'm asking a couple of questions. That's really what it means. And again, you should treat it as marketing. So no guarantees here, besides that there will be, this is where the second disclaimer comes in, there will be forward-looking statements in these conversations. These are conversations that are general and impersonal in nature. They're containing hopes for the future, for future events that may or may not take place, depending on many different factors, both within and outside of the company's control. So be aware of that. Be aware of the inherent risk to investing. Investing obviously involves risks, and the increased risk of investing in the mining industry, especially through illiquid investment products, which a lot of junior stocks out there will be. So be aware of that. And please talk to someone who knows what they're doing. Talk to a professional investment advisor, as well as just do more research yourself before taking any decisions. And you can do that by visiting setterplus.ca. It is an official website where the official filings of these companies are going to be, and they're going to tell you everything. They're obligated to tell you everything. You can read through these documents. Obviously, it's all free. I believe it's a government website, whatever it is. It's a website where you can find the official filing. So again, the disclaimers on your screen right now. There's the second one probably that's already on your screen. If you don't enjoy losing money, read both of them and be careful out there. Use your brain. With all that said, though, I will kick off the CEO interviews for today by revisiting the largest primary gold deposit in Ecuador and hearing about it from Marshall Koval, the CEO and president of Lumina Gold. Lumina is listed as LUM, that'd be LUM, on the Ventures Exchange in Canada, where an average of about 62,000 shares trade each day, with a 52-week high of 63 cents and a 52-week low of 33 cents. With a market cap of about $230 million and about 415 million shares outstanding today, this is a 55-cent stock, which, as you can see, has held up very nicely over the recent months of turbulence in the market. Adding options and warrants and RSUs to the mix, though, that leaves us at a little over 450 million fully diluted shares. The last financial statement, which is dated March 31st, shows me $6 million in current assets, most of which, so 5.8 million to be specific, is in actual cash. And the liability side of the balance sheet here is maybe a little bit more complicated than your typical junior because of a streaming deal that the company has with Wheaton Precious Metals, on which I'm also getting an update here in a minute. But outside of that, the actual payables on the right side of the balance sheet are about $1.5 million worth of account payables and other liabilities. In terms of corporate spend, that same financial statement from March tells me that on average over the last reported 3 months, Lumina spent or recorded about $320,000 a month in administrative expenses. That's excluding share-based compensation. And management and professional fees made up the majority of the bureaucratic spend here, whereas exploration expenditures were published at over $1 million a month on average over the last reported 3 months, with engineering, metallurgy, consulting, camp, and project management making up the majority of that cost over the last reported 3 months. So from a ratio perspective, this is looking good. Of course, that means that Lumina spent almost 80% of the total expense over that period on geological and project work. So that's a little over 20% on administration, basically. As it always is, though, this is nothing more than a snapshot in time. It is not necessarily fully representative of how this company runs. So please do head over to the company's website as well as setterplus.ca to look at all the numbers yourself and make sure you're getting the full picture by the time you're watching this. The more interesting part of that full picture for Lumina is their flagship Cangrejos project, which is, as I mentioned, is the largest primary gold deposit in Ecuador. Cangrejos, by the way, is a Spanish word, as my perfect Spanish accent indicated, and it actually means crabs, which don't ask me why. I'm just giving you mostly useless trivia to fill the time. But what I do know is that there is a bunch of gold and copper here. There's more specifically 11.6 million ounces in probable reserves. There's 16.8 million ounces in indicated, and there is 3.7 million ounces in inferred. In total, that would be over 32 million ounces of gold across all categories of the NI 43-101. And that is gold alone. That's not a gold equivalent number that I'm giving you here, because as I said, there is copper in here as well, with over 4 billion pounds of copper across all categories combined. So safe to call it significant. This is a globally significant asset here. And I'm not doing a full company overview because Marshall and I already had a pretty in-depth conversation about it a few months ago. And you should watch that, of course. I'll link it somewhere below. But briefly, this is a PFS stage project, which is expected to move. Well, there's actually work being done on the project right now, which is going to move it into the FS stage within the next 12 months. It's, again, large. So there's a long life mine on it, 26 years to be specific. And it has a $3.5 billion NPV 5 at under $2,000 gold. Of course, if you want to use an 8% discount rate or 10%, it might drop a little bit, but it's still globally significant, definitely at the current gold prices, which is probably why Wheaton Precious Metals also went for a $300 million metal stream, which bought them 6.6% of the payable gold production. But, and this might be a good point to start, but, and it's a big but too, the asset is in Ecuador, as I mentioned, where political winds could change almost as quicker as the Belgian coast changes its weather. And I'm kidding, of course, because nothing changes as quickly as Belgian weather. We can have 7 of the 4 seasons in one day sometimes, but it's the point is, or let's maybe turn it into a question already, Marshall, so I can start shutting up. But how's Ecuador these days? What's the latest on the political situation there?
Yeah, Ecuador has stabilized a lot over the last few months here. As you'll recall, there was a lot of violence related to some of the narco activity, and Ecuador was a transshipment point for drugs from cartels in Colombia, Mexico, Peru. They weren't a producer of cocaine. And since President Daniel Noboa has come in, he's cleaned up the situation significantly. And it went from a scenario where a lot of the Ecuadorian employees that we had were kind of living in fear for some of the violence that had ticked up. And Ecuador has been, when we entered the country in 2014, a real peaceful place within Latin America where other issues were. And, over the last couple of years, the narco activity, cartel activity, illegal mining and other things had sort of kicked up and created a lot of angst with the population, and violence and that sort of thing went up in a traditionally low violence country. So when Noboa came into office, he basically called a state of exception. He went after the cartels. He named them by name. He's cleaned it up. When he first did that, he was up in the 70% approval rating. He's done a lot for the average Ecuadorian. A lot of our employees and all, they feel a lot more comfortable in the country. They don't feel that risk is there. So he's done a lot of good things. And right now his approval rating, I haven't looked in the last few weeks, but it's plus 50%, probably around the 60% range. So there's an election coming up next year in February timeframe, and there'll be a new president in May. And Noboa looks pretty well positioned to succeed there, but we'll have to see what happens. So on the other front in Ecuador, while all this was going on, we were able to operate without any issues. Obviously, we stepped up our security for our employees and all, but I think things are heading in the right direction. And I think as far as mining goes, President Noboa was at PDAC, and he met with mining executives, myself included. And he really sees mining, responsible mining, legal mining within the regulatory framework be significant for direct foreign investment and growing the economy in Ecuador going forward. And he came out pretty strongly with that message. And so we see good support out of the administration, the current Noboa administration, for mining going forward.
So whatever's happening in the north of the country right now with the Yurimanga or Yurimagua actually copper project is you don't think that's representative of government sentiment there at all, or like what's happening?
No, I think with Yurimagua, and I don't have a lot of details. I followed it, and obviously it's a significant copper project, and it's important for the country. But that was a deal done in the Correa government time with the Chilean government. So it's a bit of a government-to-government kind of scenario, with Codelco being primarily owned by the Chilean government. So I think it's a bit different than the rest of the scenarios that you're seeing in the mining sector. Kind of a special case.
It is. That's basically my expectation on it. And also government seems almost as important as communities are becoming in Latin America. What's your most recent understanding of the community sentiment towards mining in the country as a whole, but also, of course, more specifically in your part of the country?
Yeah, so it's sort of mixed. I think there's a movement by some of the indigenous organizations, political arm Pachacutec and the Canaye, which are the kind of the national level groups that have taken an anti-mining stance as their political frame going forward. And they've challenged in the constitutional court some projects, that sort of thing. But I think it really comes down to a local scenario. And I'll give you two examples. You've got the Mirador mine in Fruta del Norte, and they're both in indigenous parts of the country. So the indigenous within the Ecuador aren't monolithic. There's the political arms that have their, they're looking at their power and their be in Congress, and actually we've had some of those leaders run for president in the past. So that's one thing. But on the local level, that really drives things. And I think very significant thing just happened recently at Mirador. They've announced the big copper project that Tongling and China Rail runs in Ecuador as Eco Corriente. They just announced a $645 million expansion of the Mirador mine from 60,000 tons a day to 140,000 tons per day in two phases. And that's in an indigenous area. So, when you look at Ecuador, it's pretty easy to just say, hey, there's opposition and anti-mining across the country, but there really isn't. So it comes down to the local level. And now what's that mean to us at Cangrejos? We're in El Oro province. It's not an indigenous province. El Oro means the gold province. And we have really solid community programs and community relations. And I'll give you an example. When, like you mentioned earlier, we're in the feasibility study stage, and we did an infill drilling program on 50-meter centers for the first 3 years of the mine life. We needed to build trails. We do manned portable rigs, build drilling platforms, and we had over 150 community members just moving drill rigs around, building platforms and trails. And we couldn't get enough employment from the nearest communities that were near us. We had to go further out to get that employment. So we've got not only in the immediate area, but in the outlying area, which should probably be defined as the indirect area of influence of the project, we've got good community relations. It's not just jobs. That's one of the key things people want, but it's also education. It's also health. It's also community activities and that sort of thing. So we have a real strong program, and we're really proud of it. And we've been able to operate continuously since 2014 with these communities nearby. Largest community is about 500 people, about 8 kilometers from the site. We don't have anybody living on the site or the infrastructure. And so, we continue to take that pretty serious. If you don't have a social license, you don't have a project.
That last sentence pretty much sums up the entire happening in Latin America, right? And about a month ago or so, you had a news release announcing that everything was going as planned for the feasibility study and new work that you're going to be doing. But it's sort of a few changes are being made, including, this might be topical to what we were just talking about, including some changes that I assume might be related to the feedback from the local communities. So talk to me about that. I mean, you're moving some of the infrastructure. What spurred that decision?
So that was more technical operational decision related to the project as we were laying it out. And the benefit was that it moved some of the infrastructure further away from communities. So it wasn't a decision driven by community concerns or inputs. It more was optimizing the project. So what we were doing is in looking at resequencing the mine, we did a couple things. In the PFS, it was 30,000 ton per day initial project, year 4 going to 60, year 7 going to 80. Now we've gone back and we're starting at 40,000 tons per day in the feasibility study and doing one expansion. Right now it's probably year 5 or 6. We're still working on that to 80,000 tons per day. And having looked at that, we're mining the Cangrejos pit first. In the PFS, the Gran Bestia pit came in year 7 after the Cangrejos pit started. Now we're going to mine the Cangrejos pit out completely, roughly over 14 years, and then backfill that pit with the Gran Bestia waste rock. So that shrunk the surface area of waste rock storage facilities that we need. And that allowed us to move the facility kind of to the northwest or northeast, sorry, of the Cangrejos pit, further away from the community. So that was the benefit of that. It wasn't driven by a community concern.
That's an important point that you made there about deciding what to mine first. But essentially, you've decided to start mining the higher grade stuff at Cangrejos and then before going to Bestia. And so I wanted to, initially when I read that, I wanted to ask you just simply how come. But then the more I looked into it, the easier it became to understand from a mining's operation perspective. And now I'm making it sound like I know what's going on. But then I thought instead I'd ask you, why wasn't this the main plan to begin with? I mean, this seems fairly obvious.
Well, I mean, it basically what you're doing, you're giving up a little bit of grade. Like in year 7 in the PFS, you moving into the phase of the Cangrejos pit and bringing in Gran Bestia, which was slightly higher grade. But when we really looked at the whole thing, operationally, it improved things. It lowers the mining costs with the haul for Gran Bestia waste. So it's pretty much a wash. Look to be a benefit for the project by doing it that way. And so that's the way we've gone.
Yeah. But why did you change your mind? I mean, why was it different before?
So if you go back to the first PEA that we did, it was 40,000 tons per day going to 80,000 tons per day. And that first PEA was done before we had high inflation. So what we were trying to do in the PFS was get a project around a billion US initial capital and balance that so that ultimately, whether we build it or somebody else comes in and takes us out, it's a broader audience of potential buyers, for instance. So mid-tiers could take on a project like this. And right now, today, you've really got 3 majors. You've got Newmont, Barrick, and Agnico. So it just gave you a broader audience of who may come in on the project. So that's why we tried to keep the initial capital down around $1 billion. And then looking at it now, we've captured in the PFS the 3rd or 4th quarter of 2022. So we caught a lot of inflation. So a lot of things are coming down now. So what we're looking at is the 40,000 ton per day scenario will be slightly higher than the PFS, but we think there's economies of scale and reorganizing the project where we can try to keep that initial capital, within sort of 20% of the PFS capital and have a much better project that gives you a better NPV and a better IRR.
Oh, okay, so you're expecting the capex in the FS to actually be lower than the PFS?
No, a bit higher.
Oh, a bit higher. Because I thought the high grade that you're going to mine first is going to make it cheaper for. What did you say? How much higher do you think it's going to be then?
It could be anywhere from 10 to 20%.
Oh,
I
okay.
used 20%. I threw that out. Yeah.
And that still keeps you, I mean, that then you're still okay with the potential buyers that you just listed here for me, you think?
Yeah, I think so. Yeah.
Okay, good. Good. Well, you mentioned actually the I suppose the most important parts from that news release here. So you're moving some of the infrastructure. There's going to be more throughput and well, higher throughput, and then you're mining the higher grade first. What else are you doing between the FS and the P? FS and the PFS.
Yeah, so we've got a really extensive metallurgical test program going on right now at FS level. And so let me back up and talk about the three main things technically that we did from the PFS to the FS. Number one was the infill drilling program that I mentioned to you to take the first 3 years of the PFS mine plan to measure so that we could report a proven reserve once the FS is done. The second part, that was about a 7,500, let's say, meter drill program. We did a similar drill program of about 7,500 meters to do geotech pit slope related geotech for pit slope design. And the idea there was to optimize the pit slopes. Maybe we could mine it with steeper slopes, and it looks like we're going to be able to do that. We're just not quite finished with the pit slope design. And then the third part was about a 3,800 meter feasibility study level metallurgical drill program. So all that stuff is done. It's underway. We're into the engineering phase now, and doing all of the layout for the different facilities. And we're in the field drilling, trenching, doing geophysics for facility siting. And we're pretty far advanced on that. So we're on track to have the feasibility study done by May of 2025. And we just got another couple of months of the field work to support the process plant foundations, the waste rock storage facility foundations, the tailing storage facility foundations, all that. So we're moving pretty quickly into the engineering phase and detailed feasibility level design. So that's going on right now. So, that's kind of where the project sits and what we're doing. But that early work that I mentioned to optimize the pit slopes, to get higher certainty on the resource grade in the first 3 years and get higher certainty with the metallurgy, those things we hope will benefit the project, right? So that's all well underway.
And with that work, you're basically certain that the new production profile, if you will, is still like, it's not sweating the asset as they call it, or it's not pushing any limits. I mean, it's still gonna be workable from an actual mining scenario then.
Yeah, so to give you an idea of that's a good point. When we did the PFS, we did the pit limiting shells of the mine plan at $1,100 gold. And then within that, we used $1,500 gold for the NSR cutoff grade. And that's how we developed the mine plan and schedule. And we're still doing that in this phase, leaving that pit shell at about 1,100. And then we may move up to somewhere between 15 and 1,700 for the NSR calculation. We haven't landed on that, and we're running the mine plan scenarios. But what that does is that brings more ounce production forward for the feasibility study than the PFS. The PFS had about 250,000 ounces a year production of gold for the first 3 years. So now we're going to be up higher than that, probably in the mid 300s, thereabouts, going to 40,000 tons per day. So that should help, the project economics. And those are the kind of things we're focusing on. The steeper the pit slopes, that'll reduce the stripping ratio. One other thing that's important in the PFS, we didn't have a low-grade stockpile. We're going to do that in the feasibility study. So that'll also lower the stripping ratio, which should help with the mining cost, right? So one of the benefits and one of the things that really drives economics on the Cangrejos deposit, or the Cangrejos mine with both pits, is the stripping ratio is extremely low. In the PFS, it was 1.26 tons of waste per ton of ore. And we think we'll be able to get between the pit slope optimization, the stockpiling, we think we'll be able to get that down below 1.2. And so that really drives mining costs, right? The lower the strip, the less the mining cost. And, you know, that's kind of what we're focused on there.
And everything else also allows for it in terms of the space that you're working with, topography, and all the other stuff that I'm not thinking about. They all allow for this type of prediction profile.
Yeah.
Okay.
We're trying to take advantage as much. We're in steep terrain, so we're trying to take advantage as much of those sort of things as we can to optimize the project.
That's a good point for you being in a steep terrain. What would that change something for you, as in like when the trucks are going up or down the mountain, as to where you place the mill and where you place this and where you place that? I mean, again, all the things that I'm probably not thinking about right now.
Yeah, that's a really good question. One of the other things that we've done between the pre-feasibility study and feasibility study is we've eliminated a fairly significant capital cost conveyor to the PFS plant site, and we've been able to move the feasibility study plant site closer to the pits and the primary crusher. So that helped. Now, having done that, we're looking at some of the waste rock hauls, a little bit more vertical haul than we had in the PFS, but all that stuff should kind of balance out. So those are the kind of things that we're engineering now. And obviously, we're always looking for the best economics with any of those changes.
But it's still a conveyor belt. That was actually a good point.
A short one instead of a long one.
Okay. Well, that also maybe conveyor belts are interesting. They're not talked about too much, I don't think, out there. Maybe they're perceived as boring or whatever. I actually like them, but they can get complicated. Like if they're too long and the two axes are not driving at the same tempo or whatnot, like it can get messy. So you shortening it actually also probably means better efficiency during production, besides lower capex and all the other things.
Yeah, and then lower technical risk.
Yeah, exactly. Good. Okay, good point. Do you think you're still going to be using a 5% discount rate? Do you think that's still fair?
Yeah, I mean that's basically what the gold industry looks at. And, you know, obviously, if there's an acquisition scenario, you'd get an acquirer that would look at something different, 8, 10, whatever they would look at for their own personal view on a project, right?
Yeah, it's kind of tough because if your competitor if your peers are using a 5%, what do you do? Do you use a 10%, and then what do you communicate to the world in that case? I understand that point.
Yeah, and the copper business for straight copper projects, it's more accustomed to see sort of 8%, and that, you know, it kind of all comes down to the weighted average cost of capital that a certain acquirer would have, and what they would use to value the project. And you know,
this is a good point, because I do want to talk about capital that you're bringing up, and you're planning to sign a new complementary investment protection agreement, CPAS, what the acronym is, that will commit you to investing over $720 million between 2025 and 2031, which sounds like quite the spend. What's the plan to make sure that you have that money to spend over that period?
Yeah, so basically the Wheaton agreement provides a pro rata $250 million towards construction of the project, the initial capital. And then you'd have to go out and you could probably project finance somewhere around $400 to $500 million. You know, traditionally with project finance banks, you know, banks like SocGen and others. Then you'd have to look at the equity raise, and this assumes that us standalone building it, right? So, you know, we've seen this level of financing out there. We believe that it can be done. So that's kind of how I look at the amount of money that would need to be raised.
Well, I suppose it's good that you have a plan for dealing with it, but as far as I understand, that's not the hope. Like you're hoping you're actually not going to have to spend all that money. But how far do you think you're going to have to take this asset before someone takes it over here?
So I mean, we continue to significantly de-risk it, right? And you're talking about the complementary investment protection agreement on top of an existing investment protection agreement we have for exploration, and that goes from we were the first one to negotiate one of these because there was no bilateral trade agreement with Ecuador and Canada, and we've upped that. We're in the process of upping that to 79 million. And then the final thing that you need is a production contract, and that sort of sets and finalizes the fiscal regime, the royalties, and all that. And we're just starting that process as well. So, and I'm going off a little bit of tangent off the financing, but then the other important aspect that we're going to be doing in the next several months is starting the environmental social impact assessment. We've got a consultant lined up. We're locking down where all our facilities are, so we'll start that work. And we hope to have most of that in process through the end of 2025 as far as the permitting. So by de-risking this project further and further, as we're doing with the feasibility study, the permitting, and the contracts with the government, then you're in a position where you're in a lot better scenario to have somebody come in and take it, right? And I think to be honest, I think we've been through a pretty rough patch with M&A the last, say, 3 years, and we're just starting to see this last year M&A activity pick up. For instance, our group had been a big investor in Osino Gold in Namibia, and they were just taken out. And a matter of fact, a Chinese company came over the top of the original takeout bid. And so that should close pretty soon. So, we're starting to see M&A pick up in a significant way. And then on the major side, you have the Newcrest Newmont deal. And so I think there's been a dearth of M&A over the last 3 years prior to this one. And within the last year, we've sort of seen that whole scenario change. So there's a couple ways to look at it. If you're at the PFS level and somebody comes in and takes you out, and I'm talking in general now, not specific to Cangrejos, there's a lot of owner preference issues related to designing and building a mine. So oftentimes through Lumina Copper, we would get to a PFS level and we're taken out by somebody, and then whoever takes you out, they can design the project the way they want to. We're trying, back to Cangrejos now, we're trying to design a project that makes the most economic sense, that is de-risked, and hopefully we'll see somebody come in and take it on. And the reason for that is, $1 billion plus sort of capital by a junior mining company, exploration mining company, whatever you want to call it. That's a big project, right? And so, that's one of the reasons why our preference would be to see somebody come in, bigger wallet, ability to take it on. We're certainly capable of it, building a company to construct this thing if we need to. But the business plan for the Lumina Group, Lumina Copper, Lumina Gold, has been take on these big assets, add value by drilling, finding more resources, de-risk them with engineering, permitting, government relations, good community relations, and then move them on to somebody that build them. An example of that is the Caserones mine in Chile was one of our projects. So, that's kind of been the philosophy, and that's what we're looking at for our business plan.
And I suppose that business plan obviously makes sense, but I suppose it's the price of the takeover that really matters here.
Sure.
And you talk about M&A. We just saw M&A in Ecuador as well this year with Adventus, which is obviously close to you as well. And I interviewed Christian the day the deal was announced, actually, and I looked through the internet for some inspiration for questions, of course. And the main point that people were arguing was like, Sure, the stock has gone up over the last couple of months, but it's still, you know, you look at the 3-year, the 5-year chart or whatever, and then it's still much lower.
Cheap.
So
Yeah.
how do you, I mean, how do you balance that? How do you balance you not having to dilute and spend a lot of money, but also not being taken over too cheaply?
Yeah, I mean, and that was part of us looking at why we went with the Wheaton deal, right? So we were looking at roughly, let's say all in 45 to 50 million to complete the feasibility study and run the company. And at the time, you know, our share price was down around 30 cents thereabouts because the whole market was depressed. So do you dilute the hell out of yourself to raise that money, or do you look at a good partner? And listen, Wheaton also did significant due diligence on this. So the other added aspect of this was you had independent third party DD, somebody that was willing to put up $300 million. That's a lot of money. And that helped us validate that we were on the right track with the project. And, you know, Wheaton continues to be, we keep them updated. We have conversations with them, and they've been a really good partner on the project. So that was a lot of why we went that direction, right?
What happens to that deal, by the way, in a potential takeover scenario? Is the money that you've withdrawn and the money that's left and a 6.6%, what happens to the deal?
So basically, the deal stays, and the acquirer has the opportunity to buy down that 6.6% down to 4.4. So that's one of the functions. There's a time limit on it. I think that I'd have to go back and look, but I think it's through 2031. I may be off there, but there's time. If there's acquired, they can basically pay for what Wheaton has invested plus a bit of a profit, and they can buy down that stream.
Okay, that's already in the agreement beforehand, which
Yeah.
because the next question would have been, do you think the agreement could be a drag on your takeover price? But I suppose your answer would be no, because you have that clause in the agreement.
Yeah, but you know, there's going to be some companies that are adverse to streams and others that aren't. But you're starting to see streaming more common place out there. I'm on the board of Equinox Gold, and we have a few small streams there. So it's more becoming more and more of a mainstream financing.
Yeah, and I think in this market, it also makes sense. Again, you have to balance that debt to equity to stream ratio, if you will. It's kind of going to become the new debt to equity debt to equity ratio. I know the timing there with the IPA wasn't right, or I mean, there was something in the news that you just in the news release that you just published with the Wheaton deal. What's all that about?
So in May, we were supposed to get a payment from Wheaton of $15 million. We got nine million. And then there was some pre-production land purchase of 1.2 million. So we got 10.2 total. Basically, one of the conditions was the term sheet on the exploitation agreement. And the government, we've been working with the government for quite a long time. Second quarter of 2023, there was a change in government. We're still engaged negotiating these contracts, and the timing just didn't meet one of the conditions. So we have till December 2nd to get that done, and then we'll get the remaining 6 million.
Oh, okay.
So that hasn't impacted our ability to operate or anything. It was just part of the deal.
Yeah, that's what I was going to ask. I was going to ask, so what does that change for you? But basically, nothing, as far as I understand it, almost nothing.
Right.
Okay, good.
So I guess the fallback is if for some reason there's further delays with the government, and it's really been not on our side. It's a change in government from the Lasso government to the Noboa government, and new ministry people in the ministries picking up. There's the Ministry of Production and the Ministry of Energy and Mines are the two main parties that we have to deal with. So we're ongoing in discussions and working on that now. So hopefully we'll be able to meet the December deadline and get that further 6 million.
Okay.
That money will come to us no matter what once we get the those term sheets in place, right?
Okay. Yeah. But you don't think that, I mean, that's not going to slow you down from publishing the FS?
No,
Okay.
no, we may get in the scenario where we have to look at a bridge financing or possibly a small equity raise, but right now it's not anticipated.
Oh, but that's how you would solve it if it was there. Yeah, it's good to know that you have a plan. How long is it going to take you then after that? And this is very forward looking, of course, but as I said, you want to have the FS out within, call it, 12 months by the end of Q2 of 2025. How long is it going to take you then to go from FS to FID?
FID meaning?
Final investment decision?
Oh, for us.
Yeah.
It'd have to be pretty close after that, within a few months, I would think.
Okay, so it's not going to be like you don't. It's not like you have to do a bunch of more drilling or anything else.
No.
Okay,
No.
good. What is the mine plan say now for how long it take to build it?
So the PFS was 2.5 years, and it's probably in that same ballpark is what we would look at here
Right.
in the FS.
Yeah, maybe not as important. I was just really curious myself. Not as important because that's, again, as you said, not your business plan.
Right.
We haven't. I mentioned drilling there, but we haven't really talked about much about exploration. You haven't also been mentioning it too much in public or news releases or whatever. What's the? Do you have exploration upside? You have a bunch of land too that's undrilled. Any plans to do something with that?
Yeah, there's sort of two levels of that. There's still additional upside, for instance, within the two pits, within Grand Bestia and Cangrejos. Grand Bestia, we can drill to the northwest and go over the ridge line and extend the resources there. We know that mineralization continues. And then at Cangrejos to the southwest and a bit to the northeast, there's potential to add ounces. So that's the near surface. That's the lower hanging fruit, let's say. And then there's other targets within the 5,000 hectare concession that we have to the north. There's two, Valorizo and howsoever, sorry, I did Spanglish there. There are two other areas that we've done a lot of work on the surface. We have porphyry and breccias up in that area. And so we got into a scenario where, listen, I mean, we got over 20 million ounces of gold and 2.6 billion pounds of copper in all resource categories. A new drill hole here or a new drill hole there wasn't really driving the stock at all. It was more about advancing and de-risking the project. So there's a lot of upside exploration still out there at blue sky, let's say, for either us or an acquirer.
That last part is what I'm thinking about because I would argue the market's not giving you any value. I'd argue the market's not giving you full value for what you have on the PFS, right? So that land is already just basically free. So would it be possible for you in a potential transaction, would it be possible for you to keep it? Would that be part of the strategy or?
It'd be tough because you'd have to divide the concession up and I think it's, listen, I think there's attractiveness if there is blue sky for an acquirer. I've been on the other side, you know, as a buyer of assets and, you know, that blue sky, you don't really get any value for it in a transaction, but you know it's there and it can extend the mine life and that sort of thing. So, you know, for an acquirer, it's attractive.
Yeah. Yeah. I wouldn't know how it is. I kind of judge by looking at the market. The market is just, again, not giving you too much value for it. Good, Marshall. What else is happening? I'm scrolling through the news releases. I looked at them before the conversation, of course, but there's I mean, those seem to be the biggest points here. What else am I forgetting to ask you?
Well, one of the other things that we're doing here is we're starting to shift towards in a few months, starting to deal a lot with the marketing of the product that we're looking at. You know, the majority of what we'll produce at Cangrejos is a gold copper concentrate, and then there'd be a small portion of doré. So what we're starting to do is talk to the off-takers. You know, that's another form of potential financing, off-taker financing or prepays. So we're going to go on a trip through Singapore and to LME in London and start to talk to, you know, the potential buyers of concentrates. So that'll help a couple things. We need to do a marketing study to support the feasibility study, but we'll start talking about potential transaction with offtake for the product that will be produced, whether it's us or somebody else. So, we're looking at Japan as markets. We're looking at Korea. We're looking at China. We're looking at India. We're looking at Germany as the primary smelter areas. And then also talk to the likes of, Glencore's and Trafigura's and those sort of people. So that's going to be an important aspect as well of the feasibility study, and then general marketing and potential financing for the company going forward.
But hang on, if your strategy is to not build this thing, so you're thinking that if you get an agreement for an offtake, that would just stay with the asset, so it's actually even more attractive for a potential buyer here.
Yeah, potentially, but you want to really nail down what the terms would be for the specific. So, for instance, the smelters will always ask for, can we have some concentrate to run our own work, right? One of the benefits of this Congreos is there's no penalty metals. There's no arsenic, antimony, mercury. So it's a very clean concentrate. So what the smelters will do is, you'd shortlist so many smelters, 3 or 4, whatever the number is, and you give them concentrate that you produce from the metallurgical test program. They'd run their test on it, and they may come back with terms and said, independent of whether we invest, this is what we would pay you for, your specific concentrates. So, if the copper grades between 15 and 25%, we'll pay you this. If the gold, so that becomes real important related to your overall economics of the project. So that's kind of where we're going with it, and see what the primary focus is, the marketability of the concentrates, and then secondarily, if there's any potential financing interest.
And you're mentioning no mercury, antimony. You don't think cadmium or bismuth might be penalty materials here?
No, they're potential penalty materials, but we're below all the penalty limits for those metals. Yeah.
Okay, because I've heard, and obviously that's not something I could verify, but I've heard some smelters would not even mind cadmium and bismuth. But again, doesn't matter in your case.
Yeah.
Good. Okay, well that'll be interesting. So what your next news release is going to be about, something along that lines, or is it going to be?
There's probably metallurgy results news release coming out. We're getting fairly advanced. Probably over the next 6 to 8 weeks, we'll be in the position, I think, to announce some of the metallurgical results for the feasibility study. Any of these government agreements that we're working on, that would be announced. And then the kickoff of the ESIA, that's the type of potential news flow over the next little bit here.
Good. You mentioned metallurgy a couple of times, and I didn't follow up on it. I should have. How's that looking so far? What are you hoping to get out of it?
So we're doing pilot plant test work. We're doing variability test work. We're doing what they call comminution, that's crushing, grinding test work, and all these inputs drive operating costs for process, and obviously metal recovery, right? So we're seeing very similar results to the PFS in the feasibility study. So, we're in I think I'd have to go back and look at the exact numbers, but roughly around 83 to 85% gold recovery overall, and about 80% copper recovery in the PFS. So we're not there yet with final results, but we're seeing very, very uniform metallurgical recoveries, and we're just trying to optimize the flow sheets and what reagents you use and what grind times and what flotation times, and that's what we're in the middle of right now. But we don't expect any significant changes, and hopefully some slight improvements over the PFS.
So no major surprises there. It's 80% on copper. How come? Like, why is it not higher? And like gold, I mean, you don't have any of these penalty materials and whatnot. Why is it not sort of in the 90s, if you will?
Well, I mean, if you look at a lot of just straight gold projects, this is more akin to a porphyry copper deposit than it is a traditional gold project, where a lot of the gold projects you would use a CIL or a CIP, which is basically a cyanide leach circuit in tanks. And, you know, for a lot of those straight gold deposits, you can get 90, even a little bit higher, mid 90 recoveries for gold. But with this thing, we've got to optimize both gold and copper recoveries, right? So the whole ore leaching that we have, and I'm getting kind of technical, but you know, some of your viewers will get bored, some will appreciate it. But we could take all the gold mineralization and we could just cyanide leach it all, which would be an enormous cyanide leach plant. And you recover about 90, maybe 92% of the gold. But then you waste all the copper revenues. Once you did that, you couldn't recover the copper. So we're recovering the copper and the gold, but our focus is from a revenue side in metallurgy. The higher the gold recovery, the more revenues we get, even with the copper. So that's what we're focusing on. We know we're going to make a copper gold concentrate, and we're just trying to optimize the gold recoveries.
Right. And if people are getting bored by this, then maybe they're in the wrong sector. Because this is actually important stuff. I mean, this makes up the economics of a project, right? I mean, it matters. So
Sure.
yeah. No, Marshall, this has been very good. I am out of questions. Anything else you want to add here at the end?
No, I think really the focus of the feasibility study is to increase the revenues of gold and copper that we mine, to get as good a mining cost, low mining cost, and that's driven by strip ratio and all those sort of things where you place your waste, and then get the lowest processing cost you can. One of the benefits that Ecuador has is low power cost, sort of just below 7 cents a kilowatt hour. They're obviously a petroleum producing country, so the diesel costs are low. So those things, power costs help lower your process costs. The low diesel cost in the country help lower your mining costs, but you still, even with low costs like that, you just want to get the best optimized plan that you can to drive operating costs down. Because at the end of the day, when you look at NPV models, initial capital is important. That goes to buildability and financeability of a project. But the NPV is influenced more by the operating cost over a 26-year mine life than it is by the initial capital. So you want to drive those operating costs, both process, mining, G&A. You want to drive those costs down as far as you can. So that's a lot of the work that we're focusing on to get a better feasibility study result.
I think you shouldn't have said that, Marshall. I think we're at 5 or 6 times higher energy costs here in Belgium than what you guys have in Ecuador. So this sounded almost like an invitation for me to move there. So if I knock on your door, don't be surprised. Jokes aside, though, Marshall, it's been a pleasure. Thank you for investing your time in me. Hopefully we can jump on a call sometime in the next few months and get another update on where Lumina is headed. But I'll let you drop off now, as I will be letting someone else in the room, and I will be traveling actually to Quebec, the Abitibi Greenstone Belt, specifically where I'll be looking at the historic O'Brien mine, the gold mine, and I'm going to be checking to see if there's more potential left there, as well as hearing about it from Matt Manson. He's the newly appointed CEO of Radisson Mining. Radisson is listed as RDS on the TSX Ventures Exchange in Canada, where an average of about 200,000 shares trade each day, with a 52-week high of 21 cents and a 52-week low of 14 cents. With a market cap of about $53 million and about 320 million shares outstanding, today this is a 16-cent stock. Management and insiders, which, by the way, includes Michael Gentile, he's on the board here, they own about 9% of the company, and 26% is owned by institutions. The last financial statement shows me $7.8 million in current assets, most of which, well, a good chunk of which, really, not, I suppose, no, it wouldn't be most, but 3.6 million to be specific was in cash and cash equivalent, and then about 3.7 million in investments with some account and tax receivables, as well as a little bit of a prepaid expense on top of that. I don't see any long-term debt, but I do see about $670,000 in account payables and accrued liabilities. And that same financial statement from March also tells me that on average, over the last reported 3 months of the year, Radisson recorded about $137,000 a month in administrative expenses, and a total of $1.1 million went into exploration expenditures for that 3-month period in total, which was about $370,000 a month on average, with drilling being a big chunk of that as well. So in terms of ratios, that means that about 75% of the total cash burn went into the ground and about 25% into administrative expenses. As it always is, though, I will keep reminding you that this financial statement is nothing more than a snapshot in time. In this case, specifically at the end of March of this year, and the finances will have changed by the time you're watching this, because this company is actively drilling. So partly because this is an active company that has to spend money to keep its light on and the business turning. So please head over to the company's website as well as setterplus.ca to look at all the numbers yourself. Make sure you're getting the full picture. As I mentioned earlier, Radisson owns a historic mine and some land around it as well, where production took place between 1926 and 1957. So over 30 years, producing a little over 500,000 ounces in that period, which came from 1.2 million tons of over 15 grams per ton gold. So a pretty significantly high-grade gold mine. It was one of the richest mines of the region, actually, for the time. And again, it's located in one of the most prolific gold belts in the world, but also definitely in Canada, being the Abitibi Greenstone Belt, where a lot of historic mines could be found, but also currently operating gold mines are there as well. There is a 2023 resource estimate on the project showing almost 1 million ounces across the indicated and inferred category at a 4.5 grams cutoff grade, or 1.2 million ounces if you drop the cutoff grade to 3 grams. There's some older met work on the project from about 10 years ago, not old, just older, about 10 years ago from 2014, showing an average grade of over 11 grams per ton, with average recoveries of low to mid 90s. So again, not too shabby at all. If you ever heard one thing from an Explorco, though, then that is that there's more potential, and it's no different for Radisson. They just announced that they are expanding the drill program to a total of 35,000 meters at the O'Brien project. 25,000 meters are going to be focused on resource expansion, and the rest focusing on step-out exploration targets, with a total of 2 drills doing all that work. So kind of a 60-40 or 70-30 split between resource growth and step-out drilling. When that news release came out in late May, by the way, they had already drilled 13,000 meters with assay spending for 11 drill holes. But there was also some assays already released, and the most recently announced assays, as a results, here came back with a highlight of 9.7 grams of gold over 4 meters, and they discovered a few surprise mineralized intervals that host wide, but I'm not going to call it low grade, but I'll call it lower grade mineralization, with highlights of almost 50 meters up to 0.84 grams per ton gold. So completely different than what was previously coming back there, which was narrower high grade. And we're definitely going to talk about all of this moving on. But just generally, a lot of drilling going on, new zones being discovered, assays are being released and awaited. A second drill has been added, and so on and so forth. There's a bunch of money in the company, so a lot to talk about there already. And also maybe a good point for me to shut up here, but before doing that, before talking about any of that more in depth here, Matt, you're the new CEO of the company. Where the news broke about a month ago, but apparently you're really only a couple of days into the job. After the company went through some back and forth on the management and the board level, talk to me about that. What's exactly happening there, and why do you think you're the right man for the job?
Yeah, I was approached 2 or 3 months ago about the Radisson position, and I've been formerly the CEO of Marathon Gold, and we transacted that company to Calibre Mining back in January. So I was available, and began doing my homework on Radisson, and I thought there was a great opportunity here, so I came on board. I mean, there's been quite an evolution over the last few months, I guess, in terms of the leadership of the company, and we've had 2 new directors join us and a couple of directors depart. So there's been a bit of a reshaping of the company to take it to the next stage. And the next stage is, is really pushing it forward into kind of a bigger profile and thinking about mining of this ore body as well, because that's where I think the potential lies.
And so your experience so far, you were with Marathon Gold. Where were you before that?
Well, I've made a career of taking single asset companies with good exploration discoveries and take it through the whole process towards production. So if you go back in my career, originally I was in diamonds. I was a lieutenant at Abrasilver, that was the joint venture partner with Rio Tinto back in the early 2000s, building the Diavik mine. So I went through the mine construction process as a witness to the process and a participant rather than in a leadership role, really. And then I was CEO of Stornoway Diamonds in Quebec. That was the last major mine to have been built in Quebec, by the way, which was an $800 million build in the James Bay area, which operated for about 8 years, and that's actually just been optioned now to Winsome Resources to have a new lease of life as a lithium mill and producer. And then I was CEO of Marathon Gold and took the Valentine project through permitting and resource growth and team building and social acceptability, and then financing and construction, and got about halfway through the build of that. And then Calibre took us out back in January, which has been a pretty good deal for all concerned so far in terms of the share value that was created there. So that's my niche, right? I take good assets with good exploration results and potential, and I push them through to becoming mines. I think with Radisson, it's an exploration project right now. It's a resource with lots of upside potential. There's a lot of wood to chop, but before this thing is a mine. But I'm not really interested as a professional mining person in just doing exploration for exploration's sake. I mean, I'm interested in projects that have the potential to be mines, and what Radisson is really high quality ounces with lots of room for growth in a fantastic address. I mean, this is the most prolific greenstone belt, the most prolific source of gold production, certainly in Canada's history, and globally probably right up there. So and when you go to the O'Brien mine, Radisson's project, and you look left and right, there's mines to the west and mines to the east. So it's the address can't be beaten.
It's unfortunate what's happened to the diamond industry really since that build that you mentioned is kind of being reduced to a pulp. That might be a conversation for a different time. But so what I understand here is that the strategy for Radisson, maybe talk to me about that. Has the strategy changed since you've come on board? Like, is the idea to try and build this thing yourself, or do you want to bring it into the PA level and have someone else build it?
Yeah, strategy hasn't changed. I mean, it's an exploration project, right? So job number one is drilling and growth, right? There's 1 million ounces right now, as you said, at a very conservative, I think, 4.5 gram cutoff. And some of the parameters behind that resource estimate last year were very conservative: $1,600 gold price, 85% recoveries. Pretty realistic mining costs to create that 1 million ounces. So I think there's more there right now with less conservative assumptions, and I think there's 2 to 3 million ounces eventually on this property. That would be the exploration target longer term. And there's a lot of drilling to be done to get up there, but at 1 million ounces right now, at the grades we've got, which is 8 to 10 grams per ton, double-digit grades for the indicated resource. So, if you dilute that down by, again, a conservative 50%, you're talking about a 7-gram head grade, and that's as good as anything in the region, right? So you have the Lapa mine, which opened in 2006, 2007. I was at the mine opening for that. I was associated with Agnico Eagle at the time. Just after I left Aber, I was hired to run a diamond subsidiary they had called Contact Diamond, and that was one of the predecessor companies for Stornoway. So I was working at the Agnico office at that time, went to the Lapa mine opening, and Lapa was about 800,000, 900,000 ounces at about a 7-gram head grade. It ran for 8 years or so, producing about 100,000 ounces a year, a little bit more. And the ore went to the LaRonde mill. which is just to the west of us, about 10 minutes drive to the west of us. So we're projects of O'Brien's current size have been mined very recently and very successfully, right? So, and that's on O'Brien's current size, and I think it's going to get a lot bigger. So this is a very real situation, and I think the message is the strategy hasn't changed. It's drill and make this thing bigger. But we're also doing all of the work, quietly, I think, in the background to diligently and professionally present this as a mining case, right? There's met work going on, there's environmental baseline work that's been done, because I think these are quality ounces that will be mined, right? So it's too early for us to be presenting this as a mining case right now. I mean, we haven't done the studies, we haven't done the engineering, but the reason I joined Radisson is that, again, this isn't exploration for exploration's sake. These are ounces that are going to go into a mill, and it's reached that threshold point, I think, already, where you can credibly contemplate that. And whose mill it goes to and under what circumstances is to be determined. But there's good things to be done here, and I'm looking forward to doing it.
Let's talk about that. Let's talk about your project in that case, because it is high grade, as you mentioned, which can, well, depending on the asset itself and the style of mineralization, can be a double-edged sword at times, because, well, many things really good. This is mining after all. It's not easy, but I'm actually specifically thinking about grade continuity in this case, because even in your case with the met work that you mentioned from 2014, it came back with an average grade of 11 grams per ton. Well, that's an average of stuff that was grading below 7.5 grams up to over 14.5 grams. Quite the range. So how are you going to be dealing with the grade continuity, and how are you dealing with it now as you're trying to grow the resource?
Yeah, well, so that's a multifaceted question. So I think the first order of business coming to any mining project is to understand the resource and the geological controls on the mineralization, right? So that's something that explorers quite often kind of skip over, right? They're just looking to get drill results out, but how do you actually understand the controls of mineralization? What is the quality of the resource estimate? Have they got a geological model? Is the resource estimate properly constrained? Are they thinking about continuity of mineralization from a geological and a resource point of view? So, when I was doing my due diligence at Radisson, I got into the technical report and the work that SLR had done in 2023 for that most recent resource. And there's been a lot of very quality work here done in all of that, right? So, and Radisson also, though, benefits from having the old O'Brien mine and all of the mapping in the stopes and on the drifts of the veins that were mined originally at the old O'Brien mine. So there's a very detailed geological understanding, and this is classic, Larder Lake, Cadillac break, narrow vein, high grade mineralization in the Piché group, which is a volcanic unit adjacent to the break, and it's dipping at 80 degrees. And there's a lot of precedent projects around there in terms of continuity of mineralization, not just from what's available in the O'Brien mine. And so I think when you're actually drilling this thing, when you're spudding new holes, when you're thinking about targeting mineralization extensions, there's a lot of data which allows you to be very predictive in that. And Radisson historically has achieved about a 75% success rate in targeting and intersecting resource grade material as extensions of the veins. And so if you look at the sections that have been in the most recent press releases, it's showing you the longitudinal sections and also the cross sections from a targeting point of view, showing you where the extensions are expected and where the drill holes have been targeted right now. So I think that's in a good place, all of that geological understanding. And I've always said that there's two things you have to have in any mining project. You have to have a high quality resource, and you have to have social acceptability, and everything else is engineering. I mean, that's a bit trite maybe, for the engineers out there, apologies, I'm a geologist, but a good strong geological model comes first, right? Now, in terms of the met work, yeah, there's been various campaigns of met work done historically. There's 2014 work. There was also work in 2018 and 2019. And so there's a program ongoing right now that I think we hope to be talking about quite shortly in our disclosure, where we're looking at the full range of grade, for example, low grade and high grade, to get the full spectrum of recoveries and grade. And we're looking at gravity, we're looking at creating a flotation concentrate, we're looking at leaching dynamics. There is a sulfide association with this ore, so how you do the leaching is very important, and what kind of recoveries you're getting there. But again, getting a recovery up in the sort of the low 90s looks like it's feasible, and with the proper work and refinement of the flow sheet. And again, the resource that was done last year just assumed 85% recovery, right? So I think I'm getting my head into the network that that's been done historically and that we're doing right now. Again, currently, and again, we expect to be able to say something about that program, what it looks like. But I think that's probably the most important technical work that's going on right now, as well as the exploration drilling, understanding exactly how the ore gets treated and what recoveries we can assume is probably a key part of the story for us right now.
Was grade variability part of the reason why the historic mine shut down? Because I believe it was getting deep, and potentially at the time technology was not as advanced right now, so it was maybe not as easy for them to deal with grade variability. Or was there a different reason why it shut down?
I think it just ran its course. I mean, it ran for about 30 years. And they were mining very high grade ore, 15-gram material, all of which we now think was in basically one ore chute, one section of the mine. About 90% of the gold recovery was coming from one system. That's actually informed the exploration model going forward to find more of those. I think they'd gone down to, I think a pretty deep level at that stage. This was the 1950s. It's narrow vein mining, different economic situation, and I think it just ran its course, right? A very classic situation. And then Radisson, of course, has really been focused. Its exploration has been focused on the eastern and western extensions, principally the eastern extension, where most of the resource currently is. We're now actually putting a couple of deep holes down below the old O'Brien mine to test, and that's, I think, been in the most recent disclosure, to test the extension of that very high grade chute. But we've kind of left that alone rather, and then just looked at the extensions either side. So I don't think there was a specific technical reason why it closed. I think it just got to the end of its natural life, given the economic situations of the time and the ore and the depth they were at and the ore they were mining.
Right. Okay. Yeah, fair point. It was, I believe it was about 1,000 meters deep that it went. So it's pretty deep for a mine.
Pretty deep, yeah.
So fair point. And again, it was the 1950s. So technology was different at the time. Are you, to go back to what you're doing and sort of in the realm of grade variability and how you're doing with that, are you going to be using tighter drill spacing this year for the next resource update?
Yeah, I think and again, I have to, I probably shouldn't speak about specific intervals that are used in the resource estimate and nearest neighbor data, because I'm, again, one day in the job here, and I'll probably get it wrong. But I think in principle, getting tight intercepts on the indicated resources is going to be required. I mean, of the 1,000,000 ounces is here right now, but roughly half is indicated and roughly half is inferred, and that would be based upon drill spacing, right? So you'll have seen that the 35,000 meter expanded drill plan, most of that is actually involving drilling the existing model and gaps in the existing model, and that will be adding indicator resources, and there'll be new resources added from that drilling. Because we're drilling gaps, but there'll also be inferred that converts to indicated with that drilling, because we're getting by definition, we're getting a tighter drill spacing. And then that's about 60 or 70%, I think, of the meters is that type of work. And then the balance of the work is going deeper, is looking for the sort of the step out extensions at depth and along strike. And that'll give us, if we hit those things, that'll give us in more inferred resources, right? So it's a bit of a balance of both. But yeah, Swiss cheesing this type of ore body, if I can use that expression, is required, right, to to demonstrate the mineralization continuity and the grade continuity to get your resource to a confidence level that you can then take to a future reserve.
In better understanding mineralization too, so is that there are no surprises later down the road when you're processing this thing and trying to get the gold out. We actually touched upon that a little bit when we were talking about the network. Have you looked at the network more in depth, as in any nasties showing up in there, arsenic, mercury, bismuth, cadmium, something else?
Well, I think almost every project in that part of Quebec has an arsenic association, arsenopyrite. So you've got to be cognizant of that. That certainly was true of the old O'Brien mine, and it's true of many projects in the Abitibi generally. So you know, the sulfide associations, pyrite, pyrrhotite, and arsenopyrite, I think. So you've got to be cognizant of that in water management, certainly. And you've got to be cognizant of that in what's going to be coming out of the mill and your tailings. And you'll probably end up with a float cotton with reasonable amount of arsenic in it. So again, that's not anything that's particularly unusual, but that's what's got to be dealt with. But otherwise, no, I don't think there's anything particularly unusual beyond that.
Let's maybe go back to drilling then. Like I actually that question would have better fitted a couple of questions ago, but I'm thinking about the resource expansion that you did. Well, not you, but the Radisson as a company did between 2019 and 2023. You basically doubled the number of meters drilled on the project to date at that point. So we went from 150 to about 300 and 1,000 meters, that is. And that more or less doubled your resource as well across all categories. That is, with a more significant bump in inferred resource, of course, smaller increase in the indicated resource. But so this is about a 1-to-1 ratio of additional drilling to added ounces. Like you're doubling the ounces, doubling the you're doubling the meters, you're doubling the ounces. Is that ratio realistic to keep going forward, or is there even room for improvement, or do you think that was a little bit too high?
No, I think it's you know, the deposit is proving to be quite predictable. So I think that 1-to-1 ratio reflects again, I think I've cited a 75% success rate in hitting the ore body, and so it's and that talks to the continuity. So as we go deeper, and as we go out along strike and to the west of O'Brien, it's very open. And again, if you look at the longitudinal section of the project, you'll see in the old Thompson Cadillac area that there were historical shafts and small operations put in by various people over the years. And so on the western side, it's called Thompson Cadillac, and that area has been drilled, hardly at all, right? So there's a little bit of that in the resource, but that's wide open. So I think as we go into those areas, and the system continues, you're going to see a pretty consistent growth in the numbers. That's the hope, certainly. And it's about $50 per ounce discovery cost so far historically when you look at the drill costs. So we're trading at about a 50 million market cap with about 1 million ounces. So we're actually trading at the discovery cost of all of those ounces, right? Which is again talks to some of the potential here to the for the company and for the valuation of the company. I think you will have noticed that there's a thesis here about these trends. There's 0 to 5, I think, identified so far, which is the thesis that this O'Brien style of high-grade vertical shoot that's the veins in a vertical orientation, giving a grade orientation of high grade, that actually repeats and continues. That seems to be bearing fruit, right? So again, and we're targeting the infill on those ore shoots and the depth extension of those ore shoots and having some success. So that's an empirical observation right now, because you're just seeing mineralization and grade results that lend themselves to that pattern of repeating vertical ore shoots. There will be some sort of structural explanation for that eventually that will be observed and worked out. But right now it seems to be an exploration thesis that's working out quite well. So yeah, I think it's a steady Eddie type approach here to the drilling. There's 2 rigs currently going. It's very inexpensive drilling. It's about $150 to $170 per meter Canadian, which is very good. And that talks to the location. So it's knocking these holes out, getting the intersections, refining the geological model, adding it into the database, re-estimating, adding ounces, and then moving on. So pretty predictable stuff.
Would you say it's at $50 per discovered ounce in terms of drilling costs? Is that what you said?
Yeah. So yeah,
Okay.
that's
Yeah, because
been
it's
the
300. Yeah, that makes sense. I suppose 300 ounces. No, 300 meters, 300,000 meters, a million ounces. That's a third of a meter per ounce. Meters 170, a third, $51. Checks out. Yeah, good. Are most of the potential added ounces that you're talking about here, are they going to come from along strike or at depth? What do you think?
you'll see in the disclosure there are holes in the existing model that are being targeted. So I think we'll get a fair number of ounces from those. But I think the bigger bang for the buck is going to come from the deeper holes that are targeting the depth extensions of these ore shoots, right? So if those hits those holes and we're targeting a bunch of the trends, that's where the bigger number of ounces are going to come from.
That's interesting because, and you also call it a predictable or steady eddy deposit here, but within those most recent assays that I mentioned at the beginning, the Pontic sediment zone was a surprise for the company. So there was wide, as I mentioned, not low but lower grade stuff, pretty much the opposite of what previously came out from assay results, where it was again narrow high grade stuff. So what's happening there? What's the thesis, and can you use some of that knowledge that you've gained for further step outs? And yeah, just talk to me about that zone.
So that's quite new, and it's not new for the region. I mean, that's the Malartic setting, right? It's lower grade sedimentary mineralization adjacent to one of the historical breaks, and these are all this, again, as you said, in the Pontiac sediments, which are the hanging wall units on the south side, and you've got the main break, structural break, and then you've got the Pichier metavolcanic rocks, which are immediately south of the break, and that's what's hosting the high grade veins. And then the Pontiac sediments begin south of that. So those drill holes were drilled from the south side, targeting the main resource zones in the Pichier group, and went through zones of broader zones of mineralization veining in those Pontiac sediments before they went into the Pichier volcanics. And yeah, and they hit. So they were sampled and assayed, and we're getting 20, 30, 40 meters of so more or less 1 gram, sub 1 gram material. So classic type lower grade disseminated mineralization. A few higher grade zones. I think there was a higher grade hidden one of those holes of 9 grams, I think, over 3 or 4 meters. So you're also getting some of the higher grade stuff in there as well. But generally, it's a lower grade dissemination, and it's a proof of concept result, because recently the company staked a lot of the ground in the Pontiac sediments south of the old mine and south of the town of Cadillac, and did a till sampling survey last year, looking for that type of deposit setting, that lower grade sediment hosted bulk tonnage type exploration target. And there is one area on that ground which has lit up with gold and till, which we're now actually putting up. I think we've got 4 or 5 holes budgeted this year to go into that, to test that. So getting the mineralization in those Pontiac sediments closer up to the main Pichier group and closer up to the main mine is demonstrating that now we've got 2 different data points that are demonstrating that those sediments are hosting gold in this location, both from that drilling adjacent to the main break, and now also from this till sampling further to the south, in that bigger property, a 75 square kilometer property. So I think this is an interesting thing for us. The focus has to remain on these high grade narrower things that are really giving us the trajectory towards future mining. But this is an interesting, I won't say side project. It's an interesting part of the story here for this property, which is developing.
That also, those findings, they prompted you to go and look at the historic data, to review some of the historic data from the project.
Yeah.
Are you going to be news releasing that, or is that just something that you're doing internally?
Yeah, I think and again, one day in the job here, getting up to speed, everything that's been going on. But the guys at the site have, very diligently. Then, when they got those hits in the Pontiac sediments, they went back and they looked at some of the older core. And yeah, there is older drill holes that are showing that type of mineralization, which are in the core shack, which weren't sampled, right? Because again, all the focus historically has been on the P shade group, narrow vein, high grade stuff. So some of those have now been sampled and that core has been sent off, and we'll see what that brings. But I think it's a classic situation really where you're drilling you're in an old mine situation. You've got a deposit model, you're targeting that deposit model, and you're maybe budget constrained, and so you're not able to assay the whole hole. You're just going for the stuff that's lighting up on the table, and you focus on that, and you're not really interested in all this other stuff you're seeing. And so, yeah, now we've got maybe the opportunity to go back and reassess some of that stuff. And I don't know what we have there yet, right? I don't know if that's, the best case scenario, have you got some sort of starter pit of lower grade material that you can maybe discover and define from that stuff? Don't know, right? But it's an interesting example of how mobilized the gold has been at this property, and seeing it in those Pontiac sediments and seeing it in those till samples. And there's also been float recovered down there in this new Algor property, it's called, that's been pretty, 7 gram in one float sample down there as well. So that's adding a nice aspect to the story.
That last part kind of makes me wonder, when you say that you still have to figure out what this thing is. It also makes me wonder why you decide to split the drilling budget the way that you did, sort of 60-40 or 70-30 between resource expansion and step out drilling, before really knowing what's sitting at the Pontic sediments. So, I mean, what's the corporate strategy behind that versus doing, say, a 90-10 bias towards resource expansion, or I don't know, a 10-90 bias towards step outs?
Yeah, it's a good question. I mean, I think again, I'll speak for the thinking behind this as far as I can. But these things are always a bit of a balance, right? You put your professional hat on and you sort of say, okay, what do we have to do here in this project? Well, we've got 1 million ounces. We're getting to the threshold where, if you put a study around that and you think about processing options, it's going to fly. And so let's put some money into converting inferred to indicated. Let's think about future studies. Let's start now, and let's do met work, and let's make sure we've got our environmental baseline. So you start thinking that professional sensibility, right? So let's put some money aside for that, because that's where this is going, right? But you also realize 1 million ounces is still just over the threshold. So, and it's going to go to more, right? And I think 2 to 3 is the target here. So where do we go for the new gold? Okay, well, down below and off to the side, and let's go for that. So, and then, we've got this exciting new, hot till sample thing, and let's plug a few holes into that. So the team gets together and you prioritize it, and you end up with your, and how this has gone is about 60-70% of the money is going towards, infill, adding ounces, but upgrading. And then these deeper holes are more kind of well catting and looking for the extensions, and then let's test that thing. And you're trying to do that without, this is a 50 million market cap company, right? We don't have a $30 million drill budget. The treasury was 6.5 million at the end of May, which is a healthy number to do all this work we're planning to do this year, and everything's fully funded, right? But you don't want to sort of, just, go crazy. And of course, the market dictates how much you can do. So you put all that into the hopper, and you end up with the program that's been delineated. And I think it's about right? I think it's about right. And I think first and foremost, I think the professional hats go on, and people sort of say, what do we have to do here, and what do we want to do?
And that's also a balance, I suppose, too, right? It's actually, when I ask about step out versus resource expansion drilling, I'm also thinking about the decision to spend virtually all the money they have right now on one season. So maybe you can talk to me about that as well. I mean, why not spend half the money this year, do 17,500 meters instead of 35,000 meters, and then do another 17 next year while kind of waiting for a better market and ensuring that you don't have to dilute in an unpredictable market?
Well, I think, yeah, the treasury at a company like Radisson goes a long way. So, there'll be money left over at the end of that program. I think the treasury stands at 6.5 million at the end of May. Again, this is very cheap drilling. Overhead in this company is very low. We don't have a big corporate overhead in this company. I'm working out of the home office here. The company's headquartered in Rwanda with a very local team. Money goes a long way. So I think given the treasury we've got, given the potential results we can achieve in that drill program this year and how much has been committed, I think it's about right.
Okay. It's a beautiful office, by the way. So good for you you can have that in your home. But I like it. I like the background. Seems like there's it seems like there's a nice little porch out there too, or like what's that?
Yeah, well, no, it's the back garden. Basically, I'm in the back of the house here.
Okay,
And
nice.
that's the hill for the Renard mine on the picture there behind me, which was pride and joy of everybody involved in that project.
Nice. Good. Good point, by the way, Matt, on that you're actually gonna have some money left at the end of this. I assume you're accounting for G&A and everything, and you're budgeting. What are you budgeting for G&A? About 1.5 million this year?
I think so, yeah. Yeah.
Yeah. Okay.
But
So you're
again, one day in the job, sitting down with the team, reassessing exactly what we're spending money on and why, and what we can do more of, and what we can do less of. But I think that's about right.
Right. Okay. We brushed up a little bit on it on the step out story of it all, which again, 30 to 40% of your budget, so still significant. What exactly are you drilling? Is it the same geological thesis where you're doing narrow, high grade stuff, or are you again is the findings of the Pontiac sediments, are they changing your approach to step out exploration as well?
I think we're still focused primarily on the high-grade narrow veins within the P-shaped group. Those Pontiac intercepts in the last press release were a bit of a welcome surprise. I don't think, other than the 4 or 5 holes on the new Alga anomaly, we're not chasing that per se right now. But I think we're going to be looking for it. All the holes that are set up from the south are going to go through it. Right, so I think we'll be looking for it going forward, but the targeting is still very much based upon the main resource veins in the P-shaped group.
Okay, so where if I'm trying to pull up a map for myself to look at, where do you think that drilling is going to be concentrated on the project?
Well, I think, and again, I'm going to try and bring up the same map. We've been targeting the trends. Right, so I think there was a press release looking at trends 4 and 5 relatively recently, and I think we're also drilling deeper holes in trends 0 and 1. Right, okay. So it's trend driven right now. 4 and 5 are the ones furthest to the east, which are pushing out the project that way, and then 0 and 1 are the ones closest to the old O'Brien mine and the main trend with the O'Brien mine.
Okay. Oh, but you're drilling that now, or is it what are you drilling now as we speak? Because again, I think that the 2 drill rigs are both turning. So what are you drilling now?
Yeah, I think we're drilling deep holes on 0 and 1.
Oh, okay. When are you expecting some assay results from that?
I think we're going to have some, disclosure within July. I would hope for our next disclosure on drill results from from probably a few drill holes that have been completed. An assay since May. I think May was the last disclosure on those holes, the ones that showed the mineralization of the Pontiac sediment. I would hope within this month we'll have additional disclosure and new results.
Batching them, I suppose, with multiple holes in one news release.
Yeah.
Okay. Yeah, that makes sense. But in all the work that you're doing here, everybody up there in Quebec happy? I mean, the community, the birds, the fishes, you're all permitted, and no one's. I mean, everybody's happy up there.
Yeah, we're fully permitted for all the exploration work that's planned. We're also fully permitted for a 40,000-ton underground bulk sample, which has been a permit that we've had for some time. So that's the natural next stage of exploration. That'll be a bigger budget operation. So we haven't approved doing that yet, and we haven't scheduled that. But that would be an exploration decline going down, and the taking of a larger sample for met reasons and for continuity reasons and mining continuity and trial mining methods. So the permitting situation is well in hand at Radisson. I was happy to see that when I was doing my due diligence. And yeah, I mean, in terms of social acceptability, again, we're right outside the town of Cadillac. And anybody who's driven Highway 117 in Quebec, and many of your viewers will have done that. You leave Val-d'Or, you go through Malartic, you pass through Cadillac, you'll see the O'Brien signs, the Radisson signs on the right-hand side of the road as you're going west, and then you go by La Ronde, at Nico's project, you go through past IAMGOLD's Westwood project, and you get to Rouyn-Noranda, and then very soon you're onto the Ontario side and you're heading towards Timmins and Kirkland Lake. So this is, in terms of social acceptability for mining, this is the center of it. There are very many companies, very many projects. There's lots of mills. There's a big, informed and experienced local population that you can't get anywhere in the world that's more informed and more accepting of responsible mining than the Abitibi. So I think that Radisson is a very local focused company. Most of our team come from Rouyn-Noranda or Val-d'Or, one or the other generally. I'm one of the real ones that doesn't. So I think that's well in hand, everything to do with that. And I think there are many. I think some of our bigger shareholders are local people, business people who have been investors for a long time, continue to be very supportive of the company, and are involved in the mining industry regionally, and are very keen to see the O'Brien mine and the Radisson project, go forward, right? So it's a very strongly supported effort in the region.
Are those the private investors that you talk about in your presentation? Because on slide 5, I can see the share structure breakdown, and it says private investors owning almost a third of the companies and 29.1%. And it says it's private investors comprise 35 investors. Are those the people you're talking about?
Yes, yeah. That's a very big shareholding from local investors, and some of those local investors are quite substantial, quite significant shareholdings. So that's a great strength of Radisson, actually, to have that.
Yeah.
And I think something I've learned in my career is that you can be living in Vancouver or Toronto or Montreal, and you're going out in your marketing and you're meeting with investors, and whether they're retail investors or institutional investors, you sometimes overlook how much of an investment your company has in the region around the project. And several times in my career, I've done investor road trips where I've gone to a small town. I've done it through Val-d'Or and Rouyn-Noranda and Timmins and North Bay. And you call up the local Desjardins or National Bank or a CIBC branch, and you say they'll all have wealth managers and wealth advisors, and you say, we want to come in and talk to you about our company. And they're always very welcoming because they don't get people calling them up. And you go in and you discover they've got 12 clients who are shareholders of your company, and they'll have potentially millions of shares, right? And so I've done this several times in my career. And Radisson is an example of that, where, yeah, there's 30, 35% of the stock is held by sophisticated business people who are local to the project, involved in mining. They are contractors, they are suppliers, and they are knowledgeable about what you're doing, and they are optimistic and supportive of your success. And first on my to-do list in this company is to develop those relationships with those investors. The company's done a very good job with that already. And that's a big that will be a big part of our future success for sure.
Are you mentioned something about the locals there that kind of got me thinking. They are obviously, they are acceptive of mining given the region. Are you dealing with any moose or goose or fishing seasons or something that you have to respect where you have to pause drilling over the summer or something?
Not really.
Mm.
Not really. It's there isn't a there isn't a caribou or or moose type seasonality to this project. I think every mining project has one dominant issue that you've got to understand from day one and address properly. For a project like O'Brien and Radisson, it's very much going to be water management, right? As it is for most of those projects in that area, right? And it's because there are sulfides there, and so you've got to be you've got to make sure that you're on top of water management, and you know the chemistry of the water you're dealing with, and you've put in place the proper resources to deal with anything that's in there, right? So I think from an environmental point of view, I think that is the primary focus and needs to be the primary focus for those projects. But again, we're talking about narrow vein mining here. We're not talking about big open pits. We're not talking about there was a tailings facility at the old O'Brien mine, which is now closed and fully closed. But with the grades we're talking about here, you're talking about a 1,200, 1,300 ton a day operation. So you're not talking about a big footprint, a big environmental impact. And again, you're right beside the highway, right? You're right beside the main power line, which goes along the highway, the Hydro-Quebec line. It's a brownfield site already in terms of the old mill building is still there. The environmental impact of this project will be the proper management of mine water.
Right. Thank you for bringing that up. That's a point that I did want to bring up here. But essentially what that means is that you can just finish your drill program in one go. Like you don't have to pause. When do you think that's going to be finished, by the way?
I think we'll go into the fall.
Okay.
It'll be continuing.
So drill results
Fall.
throughout the summer and then potentially well into Q4 this year. You have on your presentation sort of towards the end there, slide 24, it says that you're going to have a permitting update by H2 of 2024. What's that all about?
I think we just want to give. I think the thinking is we want to give a status report on where we are as a whole project, right? There'll be drill results pretty continuously through the year, and this company is able to produce pretty regularly good drill results. 10, 20, 30 meters over at grams over 1, 2, 3, 4 meters, and those results are going to come. I think the company we also want to give a status as to what some of the bigger picture stuff is. How do we see permitting here? How do we see metallurgy? And what is the broader strategy here, right? So I think there'll be disclosure coming over the next few weeks on all of that.
Good. Good, Matt. Well, I'm getting a better idea of what you are doing here. I think that's enough grilling for your first day on the job, as you said. Let's maybe pick it up somewhere in that process as you have more news coming out, more assays. What anything that I'm forgetting to ask you? Something you came here hoping to talk about, but I feel like to bring up?
No, I think the message you want to leave you with is that Radisson as a company has been around for a long time, and And but the O'Brien project's now got to the stage where it's crossed the threshold, and these are quality ounces. This isn't another case of 1, 2, 3 million ounces of sub 1 gram material that's sitting in the ground somewhere that's probably never going to be mined. This is, 10 gram per ton indicated resource, and there's now over 1 million in indicated and inferred, surrounded by other people's mills. Right? So this isn't going to stay there, right? And that's why I've joined the company, right? This will be material that will go as ore supply to a mill, right? And it's probably less likely it's going to be our mill that's built on site, and more likely it's going to be somebody else's mill, right? So that's the basic story that we want to be able to tell, what we want to tell about Radisson. This is a real situation, quality ounces in a fantastic location, surrounded by hungry mills that would love to have 7 gram per ton head feed material. And I say 7 on a 10 resource because I'm building in mining dilution and recovery, right? So again, as good as any other project in the area can supply. And so that's the story for Radisson. It's not just, oh yeah, that thing that's been there for a while and it's bumping along. This has now reached a different level of seriousness where, the job is to now push it forward and get that high grade quality material, out of the ground and into somebody's mill.
All right, Matt. Well, I think for the first week on the job, at least, this is enough grilling for now. Hopefully, I can get you back on the CEO barbecue in the near future as the work restarts, as you get a better idea of where this thing is headed. But I'll let you drop off now, as I have one more person waiting to talk to me this week, for whom I will be taking a flight to Guyana to look at some of the largest past-producing gold mines in South America and see if there's more potential in them, in a conversation with Elaine Ellingham, the president and CEO of Omai Gold Mines. This company has one of the best ticker symbols I've come across, and is listed as OMG, which is pretty much the exact reaction I get from people when I tell them I'm invested in mining. But so OMG on the TSX Ventures Exchange in Canada, there's an average of about 320,000 shares traded each day, with a 52-week high of 18 cents and a 52-week low of 4 cents. With a market cap of roughly $47 million and about 430 million shares outstanding today, this is an 11-cent stock. There are 35.7 million warrants and 30.3 million options, leaving the number of fully diluted shares at about 495 million. Management here owns about 3% of the company, 18% is owned by institutions, 8.5% is owned by Silvercorp, and almost 5% is owned by Sandstorm. Gold royalties, these numbers, by the way, might be different by the time you're watching or listening to this, because they recently did a financing that I'll say a word on here in a second. The last financial statement shows me $1.6 million in current assets, most of which, 1.2 to be specific, at the time was in cash and cash equivalents, and about 400 grand in prepaid expenses. I don't see any long-term debt, but I do see about $870,000 in account payables and accrued liabilities, part of which is in related party transactions. That same financial statement, which is dated March 31st, by the way, also tells me that on average over the last reported 3 months, Omai recorded about $67,000 a month in administrative expenses, and $150,000 went into exploration expenditures. In terms of ratios, that means that about 70% of the total cash burn went into the ground and 30% went into administrative expenses. As it always is, though, I would like to remind listeners that this financial statement that we're looking at here is nothing more than a snapshot in time. In this case, it is specifically at the end of March of this year. But the finances will have changed by the time you're watching this, partly because the company recently closed a $13 million private placement, but also because it's an active company and running a company costs money. So please head over to the company's website as well as setterplus.ca to look at all the numbers yourself and make sure you're getting the full picture. That said, we're not here to only talk about numbers and look at financials. As I mentioned, we are here to look at a potential large-scale open-pit gold mine in Guyana. Omai holds a 100% interest in a large past-producing gold mine that between 1993 and 2005, which was right around the time I was learning how to use a fork, although I'm still not quite certain how to do that. Well, around that time, this mine produced almost 4 million ounces of gold, and at over 300,000 ounces per year, it was, again, an open pit mine. with gold grades in excess of 1.5 grams per ton. And it was South America's largest primary gold producing mine for a while, which then closed down when gold prices fell below $400. The land package that Omai controls now hosts 2 orogenic gold deposits. One is a shear hosted deposit, and the other one is an intrusion hosted one with an MRE of 4.3 million ounces of gold across the 2 types of deposits combined. And the recent PEA here was done at $1,950 gold price, and it covered less than half of that MRE that I just told you about, so less than half of those 4 million ounces. But it still showed a post-tax NPV of $556 million from one single open pit with the dimensions of, call it 2.5 by almost a kilometer width. So a big boy pit is what I'd call that, costing $375 million in capex and producing gold at about $1,000 an ounce for an LOM of 13 years. That open pit deposit remains open at depth as well as along strike, though, so Omai believes there is more gold to be discovered here as the Wenot Shear corridor extends over 5 kilometers along strike. But they also believe that the other deposit, which is called Guild Creek, actually, and is an underground deposit, can also be grown. All of which, as always, sounds very positive. But Elaine, I look back at this overview that I just did, and I said at the beginning, $47 million market cap. But then you look at the PEA, over $550 million NPV on less than half of your ounces, and not accounting for any exploration upside. So what's happening? What am I missing? And why is the market not giving you any value for this asset?
Well, it's a good question. I guess I think we've been very focused at getting the job done. And this company went public through a reverse takeover in 2020. So pandemic and bad market for junior equities. That notwithstanding that, we even with a small budget, we put out 343-101 resources and a PEA in that time. So I would say we have been a little bit under the radar. That is one of the reasons why we felt we had enough resources to blast through to a PEA, despite the fact we know it's just a baseline, and we believe that mine plan is going to be much larger. But I think the other issue too is, Antonio, that past producing mines often have sort of a stigma as, why did it shut down? Did they keep looking and exploring, and did they look at any crack and crevice and there is no more? And so I think past producing mines are often a show me kind of situation. And so I think between sort of the time of our launch and the fact it was a past producing mine, I think that's some of the reason. But we're in a much better place now, and obviously doing a $13 million financing that was really included 11 top funds, North American funds, sort of states that we've kind of come out here, and it's a much brighter day. And with 13 million, we believe we can move to the next level.
Was all the money in the financing accounted for by institutions, or the majority of it?
Oh, the vast majority of it, yes.
Okay. How did you? What were those conversations like? Like, what do you have to tell institutions today to attract them to a project which is going to be, well, literally a huge hole in the ground in a jurisdiction that most of them probably cannot even pronounce? So what did you have to tell them to attract them to this?
Well, in fact, Guyana is kind of a highlight in the jurisdictional realm for mining right now. It's considered, I think a lot of people consider it one of the best emerging jurisdictions for mining. Of course, a lot of the traditional mining countries are getting wobblier and wobblier. And if you're in the North American area, your permitting timelines are so long. And also, more intense exploration in North America. So people are looking further afield. Guyana's got actually the fastest growing economy in the world, albeit from a low level, but it's got the discovery of the offshore oil. And I'm sure you've read a bit about that, but it has really transformed the economy. So if there was any concern you would have about Guyana, it's, with the relatively easy money of the offshore oil coming from an Exxon consortium, has the country turned its back on mining? And, far from it. In fact, well, as you said, Omai was the largest primary gold producer in South America. So it was a huge taxpayer. And in fact, in a relatively poor country, The time when Omai was in production, it was the heyday of economic prosperity for Guyana, other than the very recent years with their offshore oil. So yeah, they're very committed to mining because one, it's in their history. A lot of gold mining. There's also bauxite mining. But at the same time, they realize that mining opens up the infrastructure to the hinterland, to the interior. And they very much want that because, like a lot of South American countries, it's very coastal. Once you get into that interior, it gets a little wild and woolly. But we're very fortunate because, in fact, there's because of the newfound, because of the newfound wealth coming from the offshore oil, the government's investing in infrastructure. So, in fact, the road that goes by Omai is the road that goes from the coast all the way down to Brazil. And that road is already paved halfway, but the government is paving it so that by the end of this year, we'll have a paved road to within about 8 or 10 kilometers of Omai. So infrastructure is phenomenal. Yeah, so I think Guyana is a great jurisdiction.
I looked up the meaning of the name. Who came up with the name, by the way, for the mine? Because I believe that you inherited the name, I believe, when you bought the historic mine.
Yes, absolutely. It is interesting because, a lot of times people think, oh, is it an indigenous name or what are the origins? And I think that's been looked at for a long time. Nobody really knows, and the only references that I have actually, I don't know if it's true or not. It's just that when somebody found gold there, they said, "Oh my," and I don't think that's a very good story, but it's the only one I've ever heard.
Well, I read on an Italian website that it means beloved or esteemed. So it's kind of like a person that you would hold in high regard, but like someone who's close to you, like in your family, something along those lines. I don't know if that's true. I just read it.
I think I've seen something like that, but that's out of the Middle East, and I don't think that has any relationship to why it was called Omai.
Yeah. Interesting. I mean, the ticker symbol works, as I mentioned at the beginning, so that's interesting.
Absolutely.
That aside, though, to go back to what you were just talking about, what I'm kind of stuck on is looking at kind of the dimensions, the size of that proposed open pit. It's 2.4 kilometers. As I said, by almost a kilometer, 840 meters wide to be specific. That's an over 2 square kilometers mine, not project ground, just the pit itself. Is that not going to be a major community or a government challenge to permit it? How do you look at that?
No, actually, like the mine, as I said, it employed over 1,000 people in a country that only has 800,000 people. And as you know, mines always have spin out jobs outside of it. So what they typically say is for every one job at the mine, there's 5 spin-off jobs, people who provide food, transportation, whatever services. So just think about that probably 5,000 people were impacted by Omai in a country of 800,000 people. So there's a very positive feeling. In fact, I get CVs from people every day of the week, right? Operators and, medics, you name it, welders, the whole work. So people are very much looking forward to the jobs. And so when I meet with government officials, the only thing they ever ask me is, how soon can you reopen the mine? So they realize, and then with respect to communities, this is sort of the interior of Guyana. There are you're about 80, 90 kilometers from the closest community, and it is actually the second largest town in Guyana. It only has a population of 45,000 people, but it was established for bauxite mining, and there still is an open pit bauxite mine there today. So, I mean, the only local communities, well, one, there are no local communities, but they are mining communities. So as you can imagine, working at a large scale gold mine, those are pretty well-paying jobs, and they're, high-tech jobs. And if you talk to people, like I've met a lot of people that used to work at the Omai mine, and a lot of them with the wages they were receiving, they were able to send their kids to the US for education. And like it just opened the door to prosperity for full families.
That is
Right.
typically the case with mines in my brief experience that
Yeah.
I've seen as well. Why I'm asking specifically about the community is because I know that collective memory can also go back a long way. And there was I was doing some digging on Guyana and mining. There was a historic tailings dam failure in 1995, I believe, on your project.
Right.
You don't think that's necessarily going to have have left a bad taste in the mouths of locals, or how do you look at that?
No, not at all. I think there's probably a very small percentage of people that would look at that, but generally not. It's more, for one thing, that spill was extremely well publicized, but as you know, there was no significant damage. The creek that it leaked into goes into the major Essequibo River, a kilometer downstream, and the water in so only 1 kilometer away. The water in the Essequibo River never ever exceeded Canadian drinking water standards. The issue is the Essequibo River it's the fourth largest river in South America. And I always remember the stats. It flows at about 5,600 cubic meters per second. So in other words, even the leak would have diluted by something like 500 times immediately upon entering the Essequibo River. So the UN has done the UN put out a really good publication on tailing spills around the world about 10 years after that. And they considered it one that was highly publicized, but extremely low impact. So, yeah.
It happened in a different world too, I suppose. I mean, this was 1995, just a completely different mining world than what we have today. So, which is to say, now it's better technology and whatnot. So,
right. Well, I mean, obviously, no spills is the best case scenario. I mean, they are horrific things, and I think the other thing is obviously tailings technologies and how they build them and how they sort of pre-process the cyanide. It's dilute anyway, as you know, but they pre-process it even further before it goes into tailings dams these days. So yeah, I mean, it's a different world.
Yeah, exactly.
So I would just mention that the EPA in Guyana is run by very knowledgeable people, and we've been in to see them several times. And we've started the permitting process. Actually, we put in an application in January for just an environmental authorization, but now we have a full mine plan. We can actually proceed and put in an application for a mining permit. But I mean, they've already been out and inspected the site, but they know the site better than we do because, of course, they've been there since it was operating, when it was shut down. And, so we have baseline studies and things like that. So, and I think one of the comments from the EPA was that, when you guys leave, it's probably going to look better than it looks today. And that's probably very true.
Yeah.
Right.
Well, what kind of permits do you have to get between now and FID?
Really, it's I mean, it's like any country, right? But you apply for we need the environmental permit to get actually the mining license. But then before you go into production, it's sort of the standard array. You need sort of the water studies and the permits for water usage and the whole array.
Right. Anything major this year?
Excuse me?
Any major permits or something that you're applying for this year or awaiting right now?
No, because we're mostly doing drilling still to extend on the flanks. And we'll do some metallurgical studies, but really the only disturbance is still just drilling.
Right. Why I really ask you that question like that and kind of assume that you're heading toward FID rather quickly, because you've also, as you mentioned, moved it pretty quickly from since when you came on the property to the PEA stage in only really a couple of years. So what would the expectation really be for you to move this deposit into production yourself and do it as quickly as possible, or are you hanging a for sale sign on it already?
Well, I mean, I guess as a CEO, and I hope that most CEOs of junior companies look at things from the same perspective, is, it's how to create the best value for our shareholders. So at this point in time, I consider that PEA a baseline PEA. It's only based on 45% of our resource. It's only based on the open pit. We have a very robust underground deposit as well. That is, we did not include it in the PA. It wasn't because it isn't looking, economic. It's just that as a junior company, we wanted to basically get that base PEA so people could actually have a concept of how we would develop the property, right? So our next phase of work, which we're now well financed for, is really to expand the mine plan. The current PEA, as you summarized very nicely, only is production of 1.8 million ounces. We have 4.3 million ounce resource on that property. So basically what we want to do is expand the mine plan, and we've got sort of a 5-point plan on how to boost the economics. The economics are quite respectable, but we believe that it can be a larger mine plan, and more economically robust. And that path is how I believe will create the most value for our shareholders. So the good thing about mining too is, like, the path that we take is the same path, like everything we do moves the project in the right direction for a potential acquirer. In other words, moving forward on permitting, moving forward to get the mining license, expanding the deposit, bringing that second deposit into, do the engineering on that so that people can see how we would develop that. We are most likely an acquisition target. And in fact, I'm not sure I sent that to you, but Paradigm Capital, they're the brokerage firm here in Toronto that led the financing recently. And we were added to their top 20 takeover candidates about a month ago. So in other words, their senior analyst, Don McLean, he looked at our property and said, yeah, this looks like one of the type of project that, mid and even larger companies would look at to, these larger companies, they can't discover they can't always discover new deposits on their properties and where their future production's coming from. They have to look at acquisitions, and we believe that this is a prime target.
That last part is very true. That's something that I've been thinking about as well, because it is the strategy of a lot of companies out there to be taken out. For you, as you're moving this thing further along the Lassonde curve, or further along the risk curve, if you will, does that include redoing the PEA, doing an updated PEA, or do you think you're just going to jump right away to the PFS?
Well, I think we do have a two-pronged approach. We do have the one that, as I said, expanding the resource, enhancing the economics, really doing that work. We also have a second track, which is doing some of the engineering towards the feasibility study. So we would not be doing a feasibility study on this current 1.8 million ounce mine plan scenario. To me, this is a 9,000 ton per day plant. And I believe that we would be looking for a project this large at a 12,000 ton per day plant. So in conjunction with moving towards the feasibility, a pre-feas, what would be integrated into that would be a revised resource. So I don't think we would be doing a revised PEA. We'll just incorporate that into a PFS, a preliminary feasibility study.
That would make sense to me as well. And I assume you're not taking that decision on your own. You're probably talking to bankers and bigger companies in the meantime well, maybe not officially, but what are they telling you? Like, are they happy with the IRR and the size and production profile of what you have now? Or are they saying, like, call me when this is 7 million ounces and 30% IRR in a PFS?
Well, I think some of the comments we've had are as I said, they see the potential of us expanding that. They also see the underground is quite robust. So, for example, our underground deposit is about from surface, it's about 300 meters. The top of it is 300 meters down. That's not that deep for an underground. It's 1.8 million ounces, about 3.2 grams, but very wide zones. I think I've shown it to you, but up to 100-meter wide zones. So this is going to be large stope mining at least. So I think a lot of people are comfortable, like the bankers and the technical people, that will come into a mine plan once we do some more work on that and some engineering on that. So, for example, as it's been pointed out to me, there's another company in Guyana called Reunion, and their underground is 500 meters deep. Ours is 300. Theirs is 1.6 million ounces. Ours is 1.8 million ounces. We have road access, and that one is quite remote. And their grade's a little bit lower than ours. And I think one of the analysts is putting a NAV of 500 million on that alone. So I think we have a lot of room for valuation creation just by bringing that into the mine plan for the next steps. So I guess a critical point of that is I did hire a mining engineer. He's Guyanese. He's in Guyana. He actually worked at Omai when he graduated from university in Guyana. And so he went and worked around the world. He worked in the Philippines. He worked for Barrick in Tanzania. He was the chief engineer up at the huge open pit Detour mine here in Ontario. And so he's not a geologist, so he's not working on the resource expansion and things, but he's focused on some of the aspects to move things forward in a mining sense, like looking at the tailings, because as you know, we have 2 possible places for the tailings already pre-existing. So he's working on the engineering aspects. So a lot of value creation. So sort of to answer your question along, like that stuff that's directly moving us towards the pre-fees. That's the engineering type work. But at the same time, we want that expanded model. I'd like to see us out of the gate starting this mine at 12,000 tons per day. And I think any company acquiring us, that's what they're looking for, because I guess the other thing is acquisitions are an interesting thing. You know, if you're a project in Ontario or Quebec or Nevada, you know, you've got 800,000 ounces, 1 million ounces, and suddenly everybody's interested. For a company to go to a new jurisdiction, especially if they're a first entrance into a new jurisdiction, they need a larger project. You know, maybe they're not looking for a 13-year mine life. They're probably looking for a 20-year mine life. And so all of those things are those are all the right things to do. And I think right sizing Omai means a larger mine plan. And so by doing all of those things and nudging the engineering forward and nudging the permitting forward, those are the types of things that are going to create value for us, particularly in the case of an acquisition.
When I think
Like
about
a takeover.
when I think about what people or what companies are looking for in a takeover is basically big, hugely profitable mines. And so the big part of this, it seems like you're going to figure that out. It seems like that's not going to be the main challenge. What I'm thinking about, or when I ask that question, is what are they asking you about? What I'm thinking about is the profitable part, as in the IRR. You have obviously a positive IRR. What can it be higher? Like, is there something that you can do here to bump that up?
Yeah, absolutely. What we did is we basically took that whole economic study and sort of pulled it apart. Where can all of these things get better? You're right. The IRR is about 19.9% in that run. It's okay, but it's not fantastic. So why that is a bit lower is because the grades that would be mined in the first couple of years are lower. One, because you have to, for an open pit mine, you have to start from the top and go down. So there's a saprolite cover that contains some gold, but it's like 1 gram to 1.2. And then as the whole deposit that we're looking at, typical of orogenic deposits, whether you're in Ontario or Quebec, the grades increase with depth. And we certainly see that in this deposit. So what drives your IRR is really the early years. And so we have a couple of high grade targets that we've been working on over the last couple of years, and they come to surface. We can trench them. One of them runs 6 to 8 grams. The other one runs north of 10 grams per ton. They're sitting at surface. And so what we want to do is focus on those these years. And this year, we did a couple drill holes last year, and they're quite nice. They're all out there in the press releases. They would be sitting 300, 400, 500 meters from the probable mill site. And so if we even find 150 to 200,000 ounces of that near surface or at surface high grade, if you put 50,000 ounces, which would be a small percentage in the first 3 years, we ran the numbers, and that basically runs your IRR up from 19% to 28% alone. So how you address the IRR is you have to get some higher grade through in the first 2 to 3 years, like 1 year, 2 year, 3.
That would have been part of my question, actually. But maybe we'll get back to that here in a second as well, because I'm thinking about how that's going to change your capex. So is there a way for you to do that, or maybe improve on the NPV to capex ratio as the project grows?
So if we go to a bigger mill, the capex is going to go up, right?
Sure.
But at the same time, if we're going to go to a larger mill, we're probably moving to a 20-year mine life, right? And a larger throughput. So if you go to a 12,000 ton per day mill, just us running the numbers right now, we're averaging 142,000 ounces a year. But if we went to a 12,000 ton per day mill in sort of the plan we're looking at, you would be looking at about 210,000 ounces per year. So that's all going to, and so that's all going to bring your NPV up quite substantially.
So the delta between the NPV and capex is going to grow.
Much, yeah.
Okay.
A lot. Yeah.
Yeah.
So the other thing about near surface high grade is it's the type of stuff you could even start stockpiling it while you're finishing up your construction of the mill, so it's all ready to go.
Right. Okay.
Yeah.
And that's gonna, okay, yeah, that makes sense. Then that's gonna indeed increase the delta between NPV and capex. Sure.
Yeah. Yeah.
Let's start.
There's actually, yeah, sorry. I was just going to say, we have a presentation on our website, and you'll see there's one of those waterfall charts, and it kind of explains how we plan to address like expanding at the deposit, and what's going to boost the NPV, what's going to boost the IRR and things like that. So I suggest that you take a look at that, because I think that's quite informative.
I'm wondering if the market does that. Like when people look into this, do they actually think about it that way in the future? And like this deposit, what it could bring, but does the market know it, or is everybody kind of stuck on a PEA? If you could go back, would you wait before initiating the PEA?
No, not at all. It actually exceeded my expectations. So when we were in the doldrums last summer of the junior gold equities, the junior equities were just in, what is it, the Sargasso Sea that was in the middle of the Atlantic there with no winds. Last summer was just unbelievable. Like there was nothing happening, no trading, no valuations. They were just, everybody was like right down in the dumps on the junior gold equities. And so we kind of looked at it and I went, wow, back of the envelope, our drill holes were just spectacular. We added 560,000 ounces last year to Wenot. Far exceeded our expectations. So we looked and went, I think, back of the envelope, I think we can do a PEA that's not too bad. I think it was the best thing to do. And I think the market understands that anyone who looks at the deposit and looks at the property, it's pretty clear that it is a baseline PEA. We can expand it by adding the other deposit, easily by expanding Wenot. So no, and it got us out of the big pool of exploration companies, and now we're considered a developer. So I think it was a good idea.
Is that what the analysts are seeing you at? Like when you got those funds in, that's kind of what they're treating you as, a developer now?
Yeah, because I think people can now see the path, and I think we got away from the stigma that this is just an old mine, right? And I think we answered some of the questions. Like, for example, we have a tailings facility, and you mentioned the old tailings spill. After that they had built a state-of-the-art, obviously gold seal tailings dam after that, and so it still has about 2 years capacity, and we were able to get the original design plans. So the dams can be raised. So we actually have an existing tailings facility. As you probably know from a lot of companies that are building mines, tailings facilities, it's a lot of environmental studies to try and find a location to build them. It's a long process. So we have an established one that has capacity and the dams can be raised. But during our study, we had 2 engineering firms look at it. They think we should be putting the tailings in one of the old pits. So there's already above the underground, there is a pit that's 250 meters deep. And both engineering firms suggest we do that. So a lot of cost savings. It really pumps things forward faster, like from a development perspective. So I think those questions, some of that really piqued the interests of some of the analysts, because they go, oh, okay, yeah, those are a real leg up when you're building a mine.
I do want to talk a little bit more in depth about the pits, about this the super pit, as you call it.
Yep.
Because grades seem to be quite variable on both sides of the shear, and sometimes go from about 1.5 grams. They go up all the way up to, I believe I saw 56 grams per ton on one of those intercepts.
Yep.
How do you manage grade variability here?
From a resource perspective or a mining perspective? I mean,
Resource
yeah.
perspective, I suppose, is more pressing. You can talk to me about the mining things as well, but resource perspective, yeah, more pressing.
Well, there's about 12 zones, and kind of hard to describe the geology without the graphics, but yeah, there's a central contact between volcanics and sediments, and this very pronounced shear corridor developed around that. But the shearing, although it does straddle that contact, it's sometimes almost pushing almost 500 meters wide, but often 300, 350 meters wide. So there's 12 zones within that. So these zones actually are very continuous along strike, and we see that from our drilling. And that's one reason why we're able to put the resource together. But just remember that deposit was mined. So 1.4 million ounces came out of the upper part of that. And the fellow who works for me, he was working in the pit. He was an operator in that pit. And I also know in Toronto here another fellow who I saw again last week who also worked in the pit. And their comments are always, those zones were amazingly continuous, the full strike length. And so we know there's good continuity. So the variability in grade doesn't really matter. You know, when they're mining, it'll affect the size of the blocks. If you're on one of the high grade versus some of the wide lower grade. For example, last year in the sediments, we had a zone that was just over 2 grams over 70 meters. You know, in the sediments, we also hit something that was 4.07 grams per ton over 31 meters. Obviously, you're going to mine that a little differently than you're going to mine the 56 grams over 2 meters, right? But it's not a problem. It's just it's all in the mine planning, right? From a resource perspective, yeah, obviously we cap them differently. That's the only thing I would say. Like when you have very high grade zones, you cap them, right? Because they're nuggety gold for sure. So, and actually I spent a couple years on geostats and did a publication on geostatistics. So I'm very familiar with nuggety gold deposits. So a lot of my history was in Quebec and Ontario deposits. So one of the first deposits I worked on a discovery, when it became a mine, it was 15.5 grams per ton. And then I was working at a mine up in Quebec, and it was about, it must have been about 11 grams. And then I spent a lot of time on the Island Gold deposit up at Wawa, which is about 6 million ounces at 10.5 grams. So I'm used to the high grade environments, but yeah, so I think the way we approach the resources and reserves is, you know, industry standard for sure.
Is your expectation that continuity that you just brought up, is the expectation that the continuity will be somewhat similar across the entire shear zone?
The continuity of zones along the shear, yeah.
Yeah.
So when you're following a zone, yeah. Certainly the central contact, the central contact between the volcanics and the sediments, right within that there is a quartz feldspar porphyry dike, and that is extremely continuous along that contact. And often that has quartz stockworks in it. So that one, we actually tried drilling that about 3 kilometers east of the pit as well. And we can kind of pick it up on the geophysics. And we drilled it 3 kilometers to the east, and we actually hit that same quartz feldspar porphyry. So just amazing continuity of that type of thing. So
okay.
And at depth, I mean, the one thing, nobody ever knows, but a lot of these orogenic deposits, Quebec, Ontario, you see the same thing. They just get better with depth. And so the deepest hole we've done was last year, and we intersected 5.18 grams per ton over 20.2 meters. So, I mean, those are underground grades and widths, right? Those are nice zones. And I think the significance of that is that, you know, even if you take that big super pit down to 350, maybe 400 meters, there's at least 2 zones that have high enough grades and good widths that you could probably do declines and do some underground mining from the bottom of the pit. So, I mean, that's a long way in the future, but, you know, from an acquirer's perspective, companies want to see, especially if they're going into a new country, that this has the potential for a very long mine life.
What kind of spacing are you going to have to use this year, though, if you have those kind of grades in between the holes?
We're still fairly wide space, so the inferred is 150 meter drill spacing.
Yeah.
So
that's what you're doing. You're not you don't have to go like 20 meters or something like that, because like you don't have that many nuggets.
No. And indicated is 50 meters.
50, yeah, that's right.
So on the higher grade zones I talked about, yes, on those ones we're going to have to tighten up the spacing. But on the Wenat shear itself, it has good continuity along strike.
Good. So, and you've guided what 12 to 20,000 meters of drilling for the 2024-2025 season.
Yep.
Multi-folded question here, I suppose, but let's start with the first part. Which one will it be, 20 or 12?
Well, I think it's results dependent. I think in the 2024 year, we're going to aim for the 12,000 meters. So we've started with 1 drill. We're going to probably add a second drill in about 6 weeks, I would figure. Yeah. There's quite a few drills available right in Georgetown, right in Guyana. So yeah, so there's a lot of flexibility. It's only you know, to me, these deposits, there's always learning. Like we're stepping out to the east right now. The drill's set up on a hole out to the east. We know that the shear continues. We know there's gold zones out there, but as I said, there's in the order of 12 zones in the widest part of Wenat. We don't have a lot of information out to the east. We know there's at least 2 to 3 zones. We don't see 12 zones. That's why we've kind of, but we have a few geophysics. We did some IP. We've got a couple IP anomalies out there. So that is, in its own way, that's a little bit exploration. So if we have success out there, then we will accelerate the drilling out there right away.
From that 12,000 meters for 2024, yep. How is that going to be split between doing that you just told me? So expanding it along strike versus at depth?
I don't think it's good value to our shareholders at depth. What we want to do, we have a couple of deep holes. We want to add about 3 more deep holes. Just really to prove exactly what you said, the continuity. But that deposit is fairly predictable, and so we're going to do the 150 meter step outs at that lower depth, because that again gives people the comfort that, you know, hey, it's there. Me waving my arms telling you that, you know, it's down there. There's 1 hole or 2 holes to prove it. It's different. So if we get if we do a few holes of the 150 meter spacing, we can at least bring that into the inferred, and that also can bring that pit down, right?
And probably improve your cutoff grade too, though, right?
The overall grade?
The cutoff grade for at depth, because yeah. I mean, we're working at still 0.35. You know, the other thing is with the gold price where it is, eventually all of these companies were probably all going to be dropping down that cutoff a little bit as well, regardless of the depth. But the typical thing, you still, I mean, the deeper you go, obviously, the more expensive it is to get it out of the ground, right? Yeah, true. Now that we're talking about cutoff grade, I was also I wrote it down that I should ask you about the strip ratio here. Is there an option where you can Okay, that's what you mentioned at the beginning, where you consider maybe a starter pit with a lower strip and better economics to pay for capex quicker. But is there an option for you to improve the overall strip ratio, and what do you have to do for that?
Yeah, basically the PEA pit, I'll just call it the economic pit that we published that has the 1.8 million ounces produced out of that. Within that, I mentioned that there's 12 zones at Wenot. As you can imagine, if you've got 12 zones across 350 meters, when you drill them, you go through them at different levels, all the way down, right? And it's a long hole to get across all of them. So we mostly drilled from the north side of the pit. So that meant that when we got to the sediments, we were fairly deep. So we got some beautiful intersections at the west end. We know shallow where there's a lot of zones in the sediments. So within the economic pit, there are a lot of zones that were not drilled. Okay. In the shallow and the sediments on the south side. Those are all in our economic pit as waste. Okay. We're pretty sure that those, well, we know that at least some of those are going to be ore. We're not allowed to use that word anymore, but ore versus waste, we'll keep it basic. So what we're going to start doing is after about hole 4 or 5 on the east end, we're going to start putting a couple holes on the south side. And those actually could have a profound effect. The strip ratio right now is 7.8. I always, when people ask me about this project from the beginning, they said, what do you think the strip ratio is going to be? I said 7.5 to 8. So there you go. 3 years later,
Yeah.
I was pretty accurate. So it's going to have, again, some of those zones are waste, which means it's a cost, right? It's waste. And then it's not going to be just neutral. It's going to go to our revenue, and it's going to be ore. So actually by moving waste ore within the economic pit, you bring the strip ratio down. So we believe that we've kind of modeled it conservatively, and we think that we can probably bring that strip ratio down from probably 7.8 to maybe 6.5. So,
Okay, so
I mean, yeah.
So if we're talking in 3 years, that then the new 7.5 is going to be 6.5.
Sorry. Yeah, exactly.
Yeah.
And
Okay.
and if we do extend out to the east and the west, like out the west, we have 920,000 ounces. And so we did not do a lot of the shallow drilling because there were some ponds there and they were having problems doing it. We were just like, okay, let's just keep going. We'll go back and do that later. But by doing that, we actually have 500,000 ounces out in there that did not get into the economic pit. But we believe if we close that off and do the shallow drilling, some of that will come in. That also will bring the strip ratio down a bit.
Right. How
So-
is that 12,000 meters going to be split then between those different zones? Because you're mentioning the east, the west, you're mentioning the different zones. How is that going to be split?
I have it sort of, I think it's on the website, but and then we're still opportunistic. So for example, at the east, if we hit the other zones that we're going for, then we're going to allocate more out there. So we will always allocate more drilling to the areas that haven't seen previous drilling. So again, we haven't, we worked on a very limited budget last year. We actually did everything with $3 million. Okay. So Canadian. So out to the west, we know that there's a few holes out there that hit some very nice grades. So we will step out and do some there and some out to the east. So we've got, as I said, about a 5-point plan, and it's kind of outlined on the website. But there's sort of an even distribution, but I'm still an explorationist at heart. So, I mean, if we hit something that goes, that looks really good, we're nimble. That's why we're a junior, that we can be nimble and opportunistic. And actually that's got us from 0 to 4.3 million ounces in 3 years. So it seems to be working.
That's why we have forward-looking statements, right? Those disclaimers that are a couple of pages long. What
Yep.
Where are you gonna start though? What zone are you starting on?
We're on the east we're not right now.
Okay.
And then we're gonna
you're already drilling. Am I getting that correctly?
as of yesterday. Yeah.
Oh, okay, good.
Yeah.
Because that would have been my next question. When do you start drilling? How long is it going to take you to turn over some results to the market?
Basically, I think some of the other companies in country are have stopped drilling or ramped back. So our turnaround at the lab should be about 2 to 3 weeks. But of course, like when you drill a hole, right, you got to get the whole hole done. Then you have to sample it all, ship it to so probably it's probably a good 6 weeks.
Okay. And then after that, how
And
how
after
often are
that,
you
they
gonna
would
have?
be kind of continuing, right? Yeah.
Yeah. What kind of spacing in terms of time are you gonna have news releases out?
I would think every month or 5 weeks.
Good.
Yeah.
Good.
Yeah.
You don't have to do any additional network in the meantime, I don't assume.
Well, because it was mined before, we actually have, as everybody says, we have the ultimate bulk sample. We have a 40 million ton bulk sample. So fairly accurate. However, the mineralization, as I said, in the sediments, if you read all the records, historically they didn't mine it, and which is a bit puzzling because some of it's very good grade over very good widths. It's not visually impressive, and that could have been part of it. There isn't a lot of that didn't go through the mill, and so we need to do some metallurgical test work on that just to be thorough. So that I would think we won't start that till probably September or October.
Okay. And that's a 90-day test, I assume. Like, how long is it?
Something like that. Yeah, turnaround time is at least a couple months, 3
Yeah.
months. Yeah.
Okay. No, I'm just thinking why I'm kind of being specific, or maybe even semantic about the timing is because I'm trying to understand the financial situation of it all. You just raised $13 million.
Yep.
It's more than you had expected, so I assume you're going to be okay on budget. You had $1.2 million in cash in the latest financing.
Yeah.
You've spent some money since then. So how's talk to me about that. How's the budget going to look like? How far is this money going to take you?
Yeah, that's going to take us a very long way, right? Because our drill costs all in are, I guess we're just starting with a new drill company, so I'm hesitant to say exactly, but I think our costs are going to come down. If we go to 2 drills, then our overhead cost per meter goes down. So again, it gets cheaper per meter actually, right? But yeah, I mean, that would take us through to basically the 20,000 meters of drilling easily. But some met work, some more baseline water studies. The permitting is like manpower, not cost, if you know what I mean. If there's any additional environmental studies that the government wants, albeit I think we've pretty much covered those off. And we've been in touch with them. So yeah, I mean, it could get us very close to a feasibility study. I guess at the same, yeah. So, I mean, the wild cards in here is by raising that money, as you know, I am an exploration geologist originally. I mean, I've worked for a mining engineering firm and I've done the resource thing. And this project with a limited budget meant that we honed in on the low-hanging fruit. But, in our travels on that property and some drilling, we have a few of those, well, what's that? So I think the good news is that this allows us a little bit of the money to do a couple exploration targets too that could change the world. And to me, if you're an exploration company or a junior company, we have a path. We have a great deposit, well located, with a very cooperative government and enthusiastic to see mines developed. But at the same time, as an exploration, I mean, as I joined up because I looked at this and went, that looks really good. That looks like something you could do fairly easy. And it has been, as far as most projects go, this has been relatively easy building those resources. And those are new resources that were not. But some of the exploration, you have to realize, this project on those 2 deposits are only 400 meters apart. They produce 3.8 million ounces, and we now have resources of 4.3 million. That's over 8 million ounces in an area that's 2 kilometers by 2 kilometers. Okay, so you've got a 300-meter wide shear that drives through the property. Structural complexity, that there was gold in the fluids that were flowing through those rocks. So what you need to do is find more structurally prepared ground. So like we have interesting mag signatures. We have some things off of Wenot that go off in a direction where we go, huh, what's that? So I guess that's, to me, that's kind of exciting. I mean, we're going to stick to the path, but we are going to do a few occasional holes on some of these targets. And I just have a new senior geo joining us, very senior guy. And, you know, it always, geologists are only, you know, they're only as good as their last idea. So I think it's going to be exciting to get a new guy in there looking at some of it, because we have a few ideas, but we'll get a bit more feedback and then put some of the crazy assholes in that I always like doing. So.
Well, you just said that you might have some drill targets that can change the world. And if you hadn't told me you're an exploration geologist, I think I would have thought that's a little rich to say, but that's the exact thing you would expect an exploration geologist to tell you. So from a ratio perspective that I mentioned at the beginning, the exploration to administration cost ratio that I like making, I assume this year you're going to have to get a little bit better. So it's 70-30 now, give or take, but this year you're spending more money on drilling, so it's probably going to go towards 80-20.
Well, actually, your 70-30 that you looked at this year probably isn't representative, because we were working on the PEA and stuff, so we weren't drilling in the first part of this year. Yeah. I think our ratio, no, I mean, I think the telling one is our G&A was about 70,000 a month.
Right? 70 a month? I thought it was, I thought it came up with something higher. I don't think so. Look at the note something, but that's what you're targeting. You're targeting 70 a month.
Well, probably going to go up a little bit from that. Yeah, I mean, that's pretty bare bones.
Yeah. Right? Okay. Yeah. Oh, no, you're right. Actually, I got it here. 67,000 is what you had over the last reported quarter. So that checks out. Yeah. 67,000.
And the only, because we weren't actually drilling and doing our work on site, we were basically doing the resource and then the PEA. That's what we're doing the first 3 months of this year.
Right. Okay. Talking about money, there's some warrants, there's some options. And is any of that in the money already? Like what's the state of those?
There's not many warrants outstanding now. But there are some 5-cent warrants, but they were the broker warrants. So I think it's only a few million. It's nothing.
Okay.
Yeah. They're all outlined on our website. So I think there's some 17-cent ones. I think the largest number is the 17-cent warrants.
So you don't, do you think are you expecting any of that money to come in? Like you don't need it to come in, but it'd be nice, I suppose, if it came in.
Yeah, we haven't really built it into the equation. And I don't think we need to at this point, but yeah, I would hope next year sometime that some of that might come in. Yeah. I think they're all outlined on the website. As a percentage of our outstanding, it's very low.
That's right. I'm seeing it here. Well, it says 28 million warrants, 39 million options. Yeah, various prices. So you have some at 5 cents, and then there's not that many at 7. The majority is at 11, and then a decent chunk at 12 as well. That's right. It's on the website for people listening.
And there were some that just expired in June, right?
Let's see. Oh, that's right. June. Oh, yeah. Okay, those are the ones that expired. That's right. That's why it's lower than that. Okay, good. The number of fully diluted shares is what's getting up there. It's over. Let's see what it says here. It's over 500,000. Are you thinking of rolling it back? Is there a reason to do that? What's the feedback you're getting?
No, I mean no. I mean, rollbacks don't work. To me, the only time you do those is if you change the name, acquire a different project, change the direction of the company. No, and I think we're on the path. I mean, I think Reunion is in Guyana as well, and I think they're far north of 1 billion shares and 2 billion if it's fully diluted. So, although personally, I don't like seeing that number. I think it's not of any benefit to our shareholders to do a rollback. So
yeah, Reunion is up there. I think they're 1.3 billion, and they're not an Aussie company, so which it is an exception, I think, for the ventures. Are there any? And I'm going to work towards wrapping it up because I want to be respectful of your time, which I haven't so far. But are there any royalties on the project?
There's a 1% royalty that Sandstorm acquired at the time that the company went public and at the end of 2020. So they have a 1% royalty. And then the government of Guyana, of course, has a royalty, right?
Mhm.
And it's an 8% royalty. We're hoping that they revisit it, or when you do your mineral agreement. I mean, I guess they are very supportive of development. I mean, as you probably know, I've met with the president a few times,
So
and it's kind of refreshing to meet with people that are kind of listening to what you say. And often when I've met with him, he goes out and he speaks at night at some event, and he'll mention Omai. And as I said, like Omai is like a little bit of a national treasure. People remember it very fondly when it, made people's lives different, and it made the country different. So, I guess from that perspective, I'm sorry, I forgot your question.
I was
So,
asking about the royalties, and I know about the
oh yeah,
government
yeah.
part. What I'm
So
asking, yeah.
yeah. So I guess, I think an 8% royalty is fairly high from the government, but I've been told West Africa, that's sort of the lay of the land, and other places, yeah, even in Canada, it's there. So I think when we negotiate a mineral agreement with the government, I think they see profound value in large scale mines. So this is a good thing. So I think we'll do better than that. But regardless, just bear in mind that with a very small percentage, with 45% of our resource, our current resource, the NPV is not that bad for that project, and that integrates that royalty. So, right?
Yeah, exactly. What I'm asking about royalties really is does management have any royalties on this project, and how aligned are their interests? So that's where I'm coming from. But you said there's no other royalties, so I don't assume you own a royalty in the project either.
Sorry?
I don't assume you own a royalty on the project either.
Oh, myself?
Yeah.
Oh, no.
Yeah.
No.
Okay.
Wish I
Good.
did.
Well, maybe
That would
not
be
good for you.
nice.
Maybe you would have wanted to own a royalty, but hey,
Yeah.
it is what it is. Good, Elaine.
Yeah.
I'll let you go.
Okay.
This was very good. Thank you so much for investing your time in me and for this wonderful
For sure.
conversation.